Oh my, I'm just gonna snap this down right here. We have Austin Tobit with us. This is a surprise. How's it going, my friend?
It's good, man. How are you?
I'm doing good too. I did not expect this to come out today. So first question, how are you feeling?
I know you were expecting it yesterday.
I was, but then I was expecting you to take your time with it. We didn't want to rush you. So how much sleep have you gotten in the last 48 hours?
Okay, so day one, it's like, hey, here's kind of what happened. I responded to this guy's comment on just like a completely unrelated post, and he was just like, hey man, when's your next DD coming out? And I said, I'm working on one right now, probably tomorrow or the next day. And I told that to a couple people, and they like took screenshots of that message, and then they made their own post, and then I was kind of like obligated at that point, right? So I did tell, I was telling people, yeah, it'd be coming out the next day, whatever. And then so that night I was just like, screw it, I'll just do an all-nighter and I'll run through it. What ended up happening was I found something that opened up like an even bigger can of worms.
Right.
A lot of that was from like the end of this first post and stuff where it kind of left it off. And I tried to put everything in one post, and I hit the image limit. Like you can only have 20 images in a post. So I ended up doing that all nighter, and then yesterday I had to build everything back up again. I said, I'll just do it in 2 parts. So I put this part out and then I put the other one out. I did get some good sleep last night. Yeah. So around like 9 o'clock, I ended up passing out, and I don't think I rolled over at all. So I just went to bed and woke up in the same spot. So that's pretty good.
Slept like a babe. We have your too long didn't read right above your head right here. We can speak it in my voice or your voice. Would you like to do the honors and tell us what is this brand new DD? Is it better? Everyone's been saying it's better than all of the DD you've ever written. Is it better than that?
Dude, I don't know. I mean, everyone I think the everything short was pretty epic. I liked the math part about the everything short. Yeah. Citadel has no close just kind of blew the whole thing wide open with Citadel, and so I like it's like your kids, man. I love each one of them the way that they are, and they each have a specific purpose. So I think people are saying a lot of that because this was so anticipated,
right?
But then I had like 50 comments on this thing in like 4 minutes. And I know that people didn't read it.
so in that sense, you probably want people to find out about this video. So since this is your own words here, so I'll send you that link if you wanted to put it in the beginning of this post. People can join in so that they can hear you.
Yes, let's do that. Let me go ahead and edit. All right, go down to the bottom. And then as soon as I get this updated, it'll do the TLDR. Perfect. Perfect.
I was actually hoping that you would take your time because I think I'm going through a bit of a shadow ban right now on YouTube. But people will slowly trickle on in here. What's going on, guys? If you are in the house, drop some scissors either in the comments or in the live chat for Austin Tobit here, releasing his next DD, the biggest one and exclusive to you guys. You get to see his own thoughts. This is the director's behind the scenes edition here.
Somebody just reported my post says it threatens violence or physical harm at someone else.
Oh no.
Oh geez. Approved. Okay. Anyway, so TLDR is the DTC has been taken over by big money. They've transitioned from a manual to a computerized ledger in the 80s, and it played a significant role in the 1987 crash. Now, in 2003, several issuers with the DTC wanted to remove their security deposits from the DTC's deposit account because the DTC's participants were naked short selling their securities. But it turns out they were right, as I was digging into. The DTC and its participants have created a market-sized naked short selling scheme, and all this is made possible by the DTC's enrollee, Seed and Company. I think that's how you say it. SETA, CD. Somebody posted down below said it should be concede, which was kind of funny. But
that's already funny.
Yeah.
Getting
So
dad jokes in.
That's the TLDR.
Too long didn't read. The DTC is compromised. Now that said, have you heard about the lawsuits that are against the DTC? There's a bunch of lawsuits, and DTC is one of the defendants in there. We'll likely circle back around to that. But the DTC, we thought they were like an embarrassed mother on a playground, right? They saw that Melvin and co are not playing nice, and they said, okay, let me chastise my child here, maybe put out some regulations that could end up turning them to mincemeat, right? Really put the hammer down. And yet, right now, it seems like the DTC has ulterior motives and have been taken over by big money.
Yeah, so it's hard to go like one way or the other. So basically, back in the day, without getting too far into the post, you have the DTC was founded to be like this centralized clearinghouse, and with actions like I talk about in the post, there's like this blatant like slapping down the little guy so that they can go to the big money side, and effectively like the DTC is making their money off of their participants. So anybody that is a big broker, there are fees that they can charge to make money off of those big brokers. So the bigger the broker, it's just like that. It's just like the SEC and FINRA, right? Like if you're doing $1 billion in securities fraud a year, or say like 100 million in securities fraud a year, that's a bigger paycheck for us. It's the same thing for the DTC. So in a sense, it's like, yeah, they're pretty much owned by those big organizations. Now, the thing is, like, I think they're realizing that the storm that they're in has gotten so far out of control. And keep in mind, like, the DTC was founded with the best intentions.
Right.
It was a big hassle to do all this stuff with physical shares back in the day. You know, so they were kind of stepping in saying, hey, we've got this new computer and we can do this stuff really fast. And it's a lot easier because you don't have as many human errors. And so they were founded with good intentions. I think just the blatant abuse of the financial system kind of created an even bigger mess that they could take care of.
Well, in that sense, let us make sure that we actually cover each piece of this. So we have here a link to this live stream. You guys are currently watching it. And then we have your list of previous DD. If they have basically not seen any of your work, what order would you read them in the order that you have right here? Citadel has no clothes all the way to walking like a duck, talking like a duck?
Yeah. I mean, I would just go one at a time. The cool part about this post is like you can almost just read it without being exposed to any of it. I mean, obviously you're going to have maybe a better understanding. I probably explained some things that I referenced in this post, but you could pretty much just read this post and get away with it.
Okay, well, in that sense, the teacher has told us that all we need to read is this post here. Teacher, tell us a little bit more. Holy Shanolis, the events that we're living through right now are the 50-year ripple effects of stock market evolution, from the birth of the DTC to the cesspool we currently find ourselves in. This DD will illustrate just how fragile the house of cards has become. Just to set this on the record, where did this house of cards analogy come from?
So I think I started thinking about it when you and I were talking the first time. We were talking about rehypothecation, and it just seemed like it was the lower you go down the ladder, you have people that are depending on money to come from the next ladder up or the next rung up, and then you're having money come from the next rung up there. So it's like it's the fractional reserve banking system we were talking about,
right?
And so the choice was either going to be like rehypothecation or like a rehypothecation. And then when I started getting into this, I was like, well, there's more going on than just, person A owes person B owes person C. So I kind of just went with the house of cards thing because that's really what it is. It's like the entire financial system is built on this. Basically, nobody owns any of the shares. They own a promise to receive a share. And there are more promises per share than exist. And everybody's guilty of it. Everybody's playing the same game.
Jacked to the A-toe bits right here. Christy, do you like that? Is that a good motto?
Yeah, I'll tell you what, I read this guy posted something earlier. It was like, are we really seeing like, there was a minute candle marker where there was absolutely no volume. And someone posted below that and they commented and they were like, everybody's reading my DD. It's just kind of like stay humble and everything, but it was pretty funny. That's
well, for someone who has given so much time to the cause here, I'll just say on the behalf of everyone, thank you for what you have done, putting this together, putting your sleep on the line. Welcome. Thank you.
Yeah, I stayed up because I was just as committed to doing. Like I started going in, and it's just like everywhere I was looking, it was like a can was opening here, a can was opening here, a can was opening here, and it just got to the point where I was like, man, I got so my brain was like running so low on energy that I couldn't make sense of everything that I was reading. So I woke up the next morning and jumped right into it. Yeah,
that's
got
what
knocked out. So you're welcome, but I did it for me too.
He did it for him, and that's what we like to see, a little bit of ape self-sufficiency, self-reliance here. How do you want to go through? I can read, because it's on my screen, or I'm currently at the "and we never seem to learn from them" right underneath that. How would you like to go about this?
Yeah, so we can, I mean, if you want to just go ahead, man, just go. The first section right there is an overview of the DTC and its components. So yeah, if you want to just go through that, yeah.
Let's do it. In case you've been living under a rock for the past few months, the DTCC has been proposing a boatload of rule changes to help better monitor their participants' exposure. If you don't know, the DTCC stands for the Depository Trust and Clearing Corporation, and is broken into the following primary subsidiaries. So this is not a comprehensive list, but it's the ones that you need to know. Number one, the Depository Trust Company. Right, this is the DTC. Slightly different entities, right? This is just an arm of the Depository Trust and Clearing Corporation here. A centralized clearing agency that makes sure grandma gets her stonks and broker receives grandma's tendies. How does a broker receive grandma's tendies?
Yeah, so basically a broker is saying, hey, we have these shares, and these brokers are participants within the DTC. So the DTC has, let's say, like a group of 10 participants. And they're responsible for, conducting these trades. So they're going directly to the user, and they're saying, or the client, the customer, and they're saying, oh, you want 10 shares of this stock? Great. Well, you give us some cash. We're going to throw it to the DTC. And then the issuer is the person, like the actual public company that's issuing shares. They will throw shares into the DTC, and the DTC just makes that transaction happen.
Right. So in that sense, we have the main arm here. The next one, National Securities Clearing Corporation, NSCC, provides clearing, settlement, risk management, and central counterparty CCP services to its members for broker-to-broker trades. This seems like it's doing a lot of the back-end work where no one really cares how the app runs, and yet so important. What is the ape breakdown of this explanation that you have made here?
Yeah, it's just providing it's providing settlement, risk management. It's very much a lot of like what you were saying, the back end stuff. They do a lot of net trading in the back end too, so it's just like it's a lot of back end software technical stuff.
So these two added together, really important to note that the DTC essentially is the market maker or the purse strings for the purse strings, right? They have the money in order to be able to make these trades function, and the amount of money there necessarily gives insurance, a buffer for every member of this money cartel. So that's the biggest takeaway, is that they got a lot of money and they have big interest to protect that money. And so far with these regulations, we thought that they were protecting themselves in an attempt to also help us get to the squeeze. Is that interpretation still right? Or are we going to find out some pretty important bombshells in this DD?
So yeah, the initial impression was like the DTC exists. I think people thought it may have been a little more independent than it is right now. But yeah, essentially the DTC is dealing with the stock side of things. Just in the most basic terms, they're dealing with stocks. Whereas other parts like the FICC we're going to talking about exclusive to government securities and mortgage-backed securities. So the DTC is designed to keep the system fluid. Now, brokers can trade with other brokers outside of the DTC, but they have to have all the working pieces. They have to have the shares on hand. They have to have the money to exchange. Whereas the DTC, they've usually got a big deposit of this stuff. And so you could just go directly through the DTC. They get a little fee for doing it. And, necessarily have to worry so much about, well, we don't have the shares to get grandma her stock, so the DTC does. So we'll just go there. So with that being said, there's definitely some stuff here that I'm going to really leave that up to like part 2, because I already know part 2, right? I just can't put it all in one post. So so we'll get a little sprinkle of that in this podcast, this stream. But I think that they were incentivized by people, their partners or their participants. They were influenced by big money. And it's kind of like one of those Breaking Bad things, right? Like we're doing this for the right reason, but then it feels really good to be doing. We're making a whole lot of money, and ultimately it's going to come down to what our participants do. And then the participants kind of got into this big thing of hot water, where nobody really knows who owns anything anymore. And so the DTC, I think now, like the proposals that they're making are legitimate things. I think they're legitimately concerned that this system is beginning to implode. So it's kind of like everybody was friends up until the thing keeping you friends is not working anymore, so to speak.
Gotcha. So then number 3, Brandon Dale sent you a message on Reddit, the mod on Discord. Fixed Income Clearing Corporation, FICC, provides a central counterparty CCP services to members that participate in the U.S. government and mortgage-backed securities markets. Let's not belabor this. We've said CCP twice, right? Central counterparty. What exactly is that?
Yeah, so a central counterparty is just like a counterparty is the other side of the trade, right? So you have the person that wants to make the trade, and then you have the counterparty that's actually allowed to, like, person that's going to finalize that.
Right. So that in essence gives us 3 main branches that we're going to cover here of the DTCC. Depository Trust and Clearing Corporation has these 3 arms. It's not an exhaustive list, but now that we understand the players here, we also have a brief history lesson. I promise it's relevant. Should we click on there and check out this link?
Wherever we had the brief history lesson. Yeah, so this is the DTCC's website.
Gotcha. In that sense, then.
And now, if you have that on your screen, you're seeing it.
The digital museum.
You can go through all, like, if you click on 1970s, that's where I started. And so all of the information that I have in the post is just a concise kind of overview.
Wow.
Of that there. It's actually it's really cool. The info they've got it, like that first picture on 1973. I don't know if you're right there. Like those are all stock certificates.
That's so cool. So if you guys haven't,
I think that's what they are. That's pretty crazy.
If you haven't been to a museum in a while, there you go, free museum ticket on 8-bit. Next part is the DTC was created in 1973. Oh, so this is the brief history lesson. So let's make sure that we cover this. It stemmed from the need for a centralized clearing company. Trading during the 60s went through the roof and resulted in many brokers having to quit before the day was finished so they could manually record their mountain of transactions. All of this was done on paper.
Really quick, think about that. Like, think about, like, you have 8 hours of trading in a day, but you can only trade for 6 because the last 2 hours you have to physically, like, write down. Can you imagine doing that every day? And my God, that'd be crazy. So anyway, didn't interrupt you.
No problem. Like, but that is that's the paper, like, waving shares in your hand on the floor before everything became computers. This was the style of the 1970s here. All of this was done on paper, and each share certificate was physically delivered. This obviously resulted in many failures to deliver, FTDs, due to the risk of human error in record keeping. In 1974, the continuous net settlement system was launched to clear and settle trades using a rudimentary internet platform. Ooh, the internet. The internet. That's very cool.
I was tempted to refer to everything as interwebs, because, like, when you see a lot of these older posts from the 80s and 90s, they're talking about it being an interweb.
So this is important. Just as a reminder, this important history lesson is to give us context on the DTC, so we know what it was originally intended for. And then we can use it as a contrast to see, like, oh, now it's no longer serving its purpose, or maybe it's serving its purpose too well against the wishes of our GME squeeze.
Yeah, was that a question?
It's like giving you a couple of options of what are we learning about the DTC for, other than to give us a rock solid foundation.
Yeah. So It sets the table, right? Because we see a lot of things that are going on right now, and I think people just get so overwhelmed with where did this all start? Where did this begin? We can go through and we can read as many rulings or proposals on the DTC's website as we want, but most of the times you'll see, this is an amendment to a rule that was posed 5-10 years ago. And so I just went back to the very beginning and tried to give a pretty good layout kind of where they started and where the kind of the human greed took over and how that led into the crash of 87, which is what we're about to get into.
Thank you. Okay, I appreciate you leading us through this. Just clearing up a little bit, I was blocking some of the ads on the side, but now we are done, and we can clean up the screen a little bit. Okay, so here is the next part. 1982, the DTC started using a book entry only BEO system to underwrite bonds. And as a reminder, guys, we have Austin Tobit here spending time out of his full-time job on his full-time workday and leading us through his DD, which he has poured hours, days. You've been working on this for weeks. So in that sense, drop him a like on this video, go to his DD, and I'm gonna actually have to add it in the description of this video. Make sure to give this stream a like so that people can find his words on the YouTube platform. Not every person who watches YouTube is a Redditor as well, and go on Reddit and give his DD a upvote there. So in 1982, DTC started using a book entry only BEO system to underwrite bonds. For the first time, there were no physical certificates that actually traded hands. Everything was now performed virtually through computers, although this was advantageous for many reasons and made it much easier to commit a certain type of securities fraud, naked shorting. Okay, so BEO, it was basically the enabler for naked shorting to become a lot easier.
Yeah, you had... It's really hard to dispute. Like if I have this and I give it to you and there's only one of these and you have it, then I don't, right? But now if we can say like this entity over here, just off to the side, we're going to let them hold on to it. And they're going to say that I have it, right? Because maybe I bought it from them. So they're going to give me the IOU. And then you want to buy it from me. And I give you the IOU. Well, now it starts to get kind of like, okay, how are these trades being accounted for? And ultimately, who owns? Because the person that we gave this to over here still owns it. Okay, you just have a right to or a claim to it. So in that context, it makes it very hard to keep track of like, are you issuing more IOUs than you actually have shares? And the intention behind this was, if you're trading if you're trading hands multiple times a day, a system like this will let people, do day trades. Like day trading with this sort of system is much easier than every time you sell something, you got to hand it. You know what I mean? So the intentions were there. But as we're finding, like anybody that has greed is going to find a way to manipulate or abuse these systems.
Right. Okay. In that sense, BEO was an entry point for greedy people to make bad moves. 1 year later, they adopted the NYSE Rule 387, which meant that most securities transactions had to be completed using this new BEO computer system. Needless to say, explosive growth took place for the next 5 years. Pretty soon, other securities started utilizing the BEO system. It paved the way for growth in mutual funds and government securities, and even allowed for same-day settlement. At the same time, the BEO system was a tremendous achievement. However, we were destined to hit a brick wall after that much growth in such a short time. By October 1987, people are saying the bite of 87 right now in the chat. That's exactly what happened. All right, that's pretty self-explanatory. Anything you want to add to this paragraph?
Man, that's good. That's good. I think we covered it.
All right, in that sense here, the number of explanations have been offered as to the cause of the crash. Among these are computer trading, derivative securities, illiquidity, trade and budget deficits, and overvaluation. If you're wondering where the birthplace of HFTs, high-frequency trading, came from, look no further. The same machines that automated the exhaustively manual reconciliation process were also to blame for amplifying the fire sale of 1987. So Cause number 2, computer trading. This is from historynewsnetwork.org. Give us a little context on how do you do DD that gets you to historynewsnetwork.org.
Okay, I know I remember like learning about a lot of this stuff in school, and so half the time like I'm just talking when I'm writing a post, and I'm like, I need to be able to source that so people know I'm not just pulling something out. So half the time I'll like Google 3 words, right? I'll type like 1987 semicolon computerized trading platforms semicolon, just do kind of like a query, and find something that pops up. It's a credible source, and they're saying what I remember was happening. I'll throw it out, because most of the time a lot of this stuff comes from like textbooks that I had back in school. So the like for example the NYSE rule, stuff like that just comes from things that I read, when I'm doing my research.
So in searching for the cause of the crash, many analysts blame the use of computer trading, known as program trading, by large institutional investing companies. In program trading, computers are programmed to automatically order large stock trades when certain market trends prevailed. However, studies show that during the 1987 US crash, other stock markets which did not use program trading also crashed, with some with losses even more severe than the US market. So let's look at that last sentence, because that sounded very much like an M. Night Shyamalan plot twist here.
Yep. If you actually click that, I think it's that link right there below it. That's coming from the History of the Federal Reserve.
Okay.
And they're the ones that dubbed this as like the first global financial crisis. So what was going on here is you have day-to-day transactions are going on like this. Everything's smooth. Everything's fine. Every now and then you'll see like a ripple. Okay, you'll see a ripple.
Right.
But what you're not seeing is like, that's the surface. If that's like a pond, a flat pond, if you're looking at a pond, like nothing's going on if it's flat. And then what you don't see is like, it takes a lot of turbulence under the water to make a ripple on the surface. And so there were all of these things going on underneath the surface that as soon as something was triggered, which I think that article, events leading up to the crash, that's response is probably there. Someone did an analysis here, and it may not be this, but two people did an analysis after the crash of 87, and they published it in 1989. And there was something like a bank stopped accepting they gave a notice that they weren't going to accept like a certain sort of tax write-off or something.
Okay.
And it was a big implication. It was a really big implication. And then it was like after that was posed, then it was like Wednesday, Thursday, and Friday of the week before the crash, the stock dropped 10% in 3 days. And then Friday or Saturday and Sunday market was closed. As soon as Monday came, boom, it tanked like over 20%. So those events that in the week prior were caused by that initial news of we're no longer going to accept a certain type of tax write-off or tax discount or something like that. And then, so going back to that pond analogy, underneath the surface, things started to churn and bubble. And one domino knocked into another domino into another domino. And what happened with the high frequency trade or with their trading system, but the DTC system, was these not just the DTC system, but I mean, you have like institutions that are trading on computers by this time too. But as soon as those computers realized like there's a bigger sell-off than normal, they started selling everything.
Okay.
So you have one event that triggered these computerized platforms to just start selling everything.
So in that sense, it's very similar to how we have coerced buying squeeze events that are likely to trigger one versus the other, right? The margin call squeeze. This is very similar to the margin call squeeze, even if you don't participate in illicit activities, right? Eventually, you're going to get caught into this program trading as well. Yeah,
that's exactly right. And it's the reason why if you have a high short position in like AMC, and you have a high short position in GameStop, like if something is being margin called, it's just a matter of time before something else gets margin called. And so people will try and rush in and fix everything before the next party tries to fix everything and send the price up even higher.
Roger that. Okay, the last sentence, just as a repeat of what Austin just said, indicates a much more pervasive issue at play here. The fact that we still have trouble explaining the calculus is even more alarming. The effects were so pervasive that it dubbed the first global financial crisis. That's the link we just saw. Also a great summary published by the New York Times. To be fair to the computers, they were programmed by fallible people and trusted by people who did not understand the computer program's limitations. I have to tell you, in the tech industry in Silicon Valley, this is still the case. So many people have no idea how these computers work, and ultimately those people are the bosses of the people who actually do understand how this works.
And it's scary. AI right now is scary.
Yes.
I could talk to something that you think is a person and it's not. It's pretty wild.
Getting closer and closer to some people are saying you should be careful for your safety. So once again, you came on the show. I was like, you want to show your face for real? That was like weeks ago. Started our friendship there. Have you been harassed by anybody recently?
Dude, nobody has done anything to me so far. I mean, I've received a couple hate comments, but everybody does. Just kind of brush them off. At this point, like it's like I feel like the majority of stuff that I've thrown out, and it might be another thing if like everything else is completely quiet, and I put something out there that stirs it up. But there's so much going on right now, man. Like even when I'm doing the research for this DD, like if I'll Google, something about hedge funds, and like the latest, maybe somebody defaults or something, or suffers a small default or something, and then I Google something 2 days later, there's more. So like this is going on everywhere, and I feel like as much as I am exposing a lot of it, I'm just putting things together in a story for people to digest. So it's at the point now where it's like if they're gonna, especially with all the overtime they're working in their offices, right? If they're gonna take the time out to come and do something to me, then so be it. But I haven't had anybody. It's another thing too. I just have to say, like, I appreciate when people are on Reddit and they're saying like, we haven't heard anything in like 10 hours. Guys, I was passed out. I wasn't being headhunted. Like, don't worry about it.
They haven't talked in 30 seconds. Seriously.
Yeah. And, but it's okay. I appreciate the love from everybody. I really do. But if you don't hear from me in like weeks, yeah, I might want to send somebody up.
And Austin and I will set something up. We'll just text each other back and forth a secret code every now and often. But like for a man, thank you so much for supporting this stream. For example, Austin is giving his time. We have almost double the amount of people that we had last time we shouted this out. But again, if you guys care about getting Austin's message out on YouTube, not just on Reddit, not everybody who is a Redditor also not everyone on YouTube also is a Redditor, so let's try to get this chat up to 1,600. That's 1,000 more likes than we have right now, because we have 3,500 people in here, and that the math has to check out. Anything you want to say about this section before we go on to the extremely relevant explanation from Bruce Bartlett?
I'm just trying to find out where we were. No, we're good. We're good.
Should we click these links on explanation from Bruce Bartlett?
Let's see. You can. It's that. So it's the case or the cause 1, cause 2. It's just a list of those. So Bruce Bartlett is he's a pretty reputable guy. He was, when he says things, people generally tend to believe him. He's pretty high up there in Washington. That link that I had on there, one of the most influential writers in Washington today. He's I hadn't heard of him before I did this, but I just did a kind of a quick fact check to make sure that I wasn't posting garbage. And he seems really, really credible. And I think what he said here is spot on, because it's what I grew up learning too.
Looks like this is from a snippet of this link. Cause number 1, derivative securities, from Bruce Bartlett. Initial blame for 1987 crash centered on the interplay between stock markets and index options and futures markets. In the former people buy actual shares of stock. In the latter, they are only purchasing rights to buy or sell stocks at particular prices. Thus, options and futures are known as derivatives because their value derives from changes in stock prices, even though no actual shares are owned. Then you highlight the last sentence, which is concluded that the failure of stock markets and derivatives markets to operate in sync was the major factor behind the crash. So this is in addition it's explaining the 87 crash with in addition to program trading.
Yeah, that's right.
Okay.
The balance sheet and the portfolio of all of these funds, they were starting to get more into like the risky derivative side because they realized that up until this point, people would trade a stock. And then if the stock was $10, they would make bets on what the stock was going to be in the future. And so it's a derivative, which is what he's explaining here.
Right.
But what they realized was if they start overvaluing this, sometimes it would bring up this. And that's the desynchronization. And that's extremely similar to what we see. I've been ranting and raving for months now about Citadel has like 80% derivatives. They've 80% of their portfolio are shorts and calls. Or calls and puts, and only 20% are physical shares. And so as soon as I read this, who do you think I thought of? It's like Citadel.
Right.
So that's why that was relevant.
So here, notice the last sentence. The major factor behind the crash was a disconnect between the price of stock and their corresponding derivatives. The value on any given stock should determine the derivative value of that stock. It shouldn't be the other way around. This is an important concept to remember as it will be referenced throughout the post. So just to make sure that no ape gets left behind, maybe we can even draw this out. How should we remember this since it is going to be referenced throughout the post?
So this is really like wait until post 2.
Okay.
Wait until the second part, because this is one of those things where I had this written out, and the thing got so long it was just hard to follow. So, but when post 2 comes out and I start talking about balance sheets and all these companies that are extremely over leveraged, you'll want to remember that.
Okay. In the off chance that the market did tank, they hoped that they could contain their losses with portfolio insurance. Another article from New York Times explains this better in detail. So there's your link and a snippet. This is the most well put together DD. It's not rushed at all. You have the links there, but then you also bring out the snippets of what we should actually pay attention to, so people can read more if they wanted to. This is the ideal DD right there.
Thanks.
Yeah, they would simply sell ever-increasing numbers of futures contracts, a process known as dynamic hedging. The short position in futures contracts would then offset the losses caused by falls in the stocks they owned. As computers dictated that more and more futures be sold, the buyers of those futures not only insisted on sharply lower prices, but also hedged their positions by selling the underlying stocks. That drove prices down even further and produced more sell orders from the computers. So is this kind of like a coerced selling action that because the computers...
This was an accident.
This is an accident. Basically, it's kind of like telling a computer, if a lot of people are selling, make sure you sell as well. Well, if everybody has that, that's an endless loop.
Yeah. So read the rest of it, and then I'll explain, because I'm just going to jump into the rest of it.
Sure. Everyone would know the selling was not coming from anyone with inside information, so others would be willing to step in and buy to take advantage of bargains, or so it was believed. So there is this force that was supposed to counterbalance this coerced selling action. Anyone who did step in with a buy order quickly regretted the decision. So people who would step in, they would get burned.
Okay. I think if maybe I would have put this post out, or if I would have known that this existed before I wrote the thing about Citadel and their high frequency trades, people would have maybe understood the high frequency trade a little bit more. So what this is saying here is they built this program that said, here's the way the market normally works. It stays in this channel. People are buying, people are selling. But then when you break outside of that, if you don't have any insider information or something to tell you, this is happening for a reason, the company's going bankrupt, whatever, you should probably just buy the dip, right? And so that's what these programs were designed to do. The problem was when the market started to go too far down without being picked up, the people were overconfident in thinking that the program is going to correct and it'll go back in and say buy. So what they did was they tried to take it even more advantage and tank the price even more by selling out these futures contracts, which futures contracts are still an option. You don't have to activate it. But what happened was, like, say the hedge fund or the trader owned the security, and they were selling someone the right to purchase that security from them in the future. So they were driving the price down by issuing those. And then to drive it down even further, they sold the stock too. So they were selling two financial instruments into the market. Mm-hmm. And when they did that, the trading platform, the automatic platform, sold even more. So it reached a point where it was like, there is no going back. And that's what they didn't realize. They're thinking, oh, it's gonna correct itself as soon as someone gets in and buys. Well, that's what the last sentence was, because somebody did jump in and try to buy the dip. And it just kept going down, and everybody lost money. There was no rebound.
So there's basically two blind people guessing what the price of the stock is. And this time, it used to be like thousands of blind people guessing what the stock is, but these two blind people didn't coordinate very well. And then they decided one of these was these program traders here. And their algorithm said, if the price starts to plummet, make sure that you sell. But also make sure that, because there likely is going to be a correction here. So these are the robots, right? So these people are not maliciously trying to hurt the stock. They just want to not be on the wrong side of a major sell-off. So those are the bots there. But on the other side, just to make sure that I understand, they are also selling not only the stocks, but the futures as well.
Yes.
So are those the programmatic traders, or is there something else in the wake of this? What are the agents in this story?
So the agents are just the same thing as today. You have people that are trading, brokers, people like you and me, they're trading, and people like you and me, we're sitting at home. We think everything that we're looking at on a screen is done by other people on the screen, but it's not. Right. The majority of trades that happen now are done on these computers that are put into the system. They're supposed to be like live in real time, but every now and then, all you have to do is suppress the buy side for like 5 seconds, and it dramatically changes the price.
Just like how Robinhood.
If you have the option, yeah, exactly. And so the problem is, like, you can do this every now and then and kind of get away with it. But when you suppress the price of a stock that's trading, it's really highly volatile. You can tank a third of its value in a matter of minutes. And that's what Citadel is getting caught doing. They were suppressing buy orders in order to find better pricing targets for them. So this is happening by, just the regular, like, mom and pop or the average Joe is not aware of any of this that's going on. They're thinking that, volume is dependent on, like, you don't have people going into GME and trading 4 million shares one day and then 50 million the next. That's not a people thing.
Right.
It's not a people thing at all. People don't just wake up one day and say, I think I'm going to buy GameStop. I mean, maybe we do, right? But yeah, all of this is being done on computers. And so even looking at what happened in 1987, the 1987 crash, a lot of that was played in part by those programs that weren't as sophisticated as they are now. The problem didn't go away. They just made the machine more accurate.
Right.
And now it's like have more control over, instead of the script saying keep selling, they can just turn the script off and tell it to buy, because they know if the majority of trades are done on their program, then they can buy at any time and pump up the price of a stock. And people now think, oh, we're going back up, so I'll buy in. So everything is done behind the scenes without you even knowing about it. And this is where it started.
Gotcha.
Significant part.
So this is the origin story of that house of cards, as the title of the DD suggests. So there's little baby investors here with small little upward momentum trying to push the stock up, but then these are the people that quickly regretted their decision, because ultimately the people that looked at the bots and the bots looking at the people, that negative pressure compounded because of an unsophisticated algorithm wrote by fallible humans until the entire market started to see a major crash. Okay, great context. Let's keep going. A major disconnect occurred when these future contracts were used to intentionally tank the value of the underlying stock. In a perfect world, organic growth would lead to an increase in the value of the company. They could do this by selling more products, creating new technologies, breaking into new markets, etc. This would trigger an organic change in the derivative's value because investors would be, hopefully, more optimistic about the longevity of the company. It could go either way, but the point is still the same. This is the type of investing that most of us are familiar with, investing for a better future. And so once again, we don't want to spend too much time on the 1987 crash, but we have the program investing, that these algorithms are looking at a pullback or perhaps a correction, and then seeing that is a moment for them to dogpile on that negative price action. When this was compounded by not only selling futures contracts, but also the stocks themselves, we have the large proportion of the regular investors or even institutional investors, people who are not bots, also buying into that crash mentality and then pulling out their stocks as well. Only the sum of the people that decided to actually buy in, the people that were supposed to be part of this market correction, right, correcting it from this crash, they would have regretted their decision immediately because the combined efforts of everybody selling at once was too great. So
that's right. That's right.
Austin doesn't want to spend too much time on the crash of 1987. Hold on, Just Cheese is asking a question. If there is something like 200 million outstanding shares, wouldn't everyone calling their brokers and asking for their physical shares on paper rectify the effed up books, show us their real shares? So we have been waiting for a round for that. 420 came and is now gone. So we can talk about recalling shares soon, especially if Austin wants to. But let's keep on pushing through the DD.
Yep. I mean, I'll address it right now real quick. Sure. What I'm getting back, like I keep asking myself, like, why aren't we recalling our shares? Like, that's what I just, like, I don't know how hard or complicated the process would be. I know it took Dr. Burry like weeks or months to actually get his shares, like certificates for his shares. And I don't want to go too much in because we're getting really ahead of ourselves, but I don't know why more of us aren't requesting our shares. Like I'm probably going to do it very soon. Say, okay, I've got X number of shares in GameStop. I want all of them. I want proof of them. And I think if we did that, it would probably expedite this. Like in every heavily shorted stock that people own, they're banking on the fact that you won't ask for your share. That's pretty much it. So
if you haven't called your broker yet, we have a video from like a week and a half ago trying to anticipate the April 20th recall that you guys should check out. So a major disconnect occurred. He doesn't want to spend too much time on the crash of 1987, just want to identify the factors that contributed to the crash and the role of the DTC as they transition from a manual to an automatic ledger system. The connection they really want to focus on is the enormous risk appetite these investors had. Think of how overconfident and greedy they must have been to put that much faith into a computer script. Either way, same problems still exist today. So that is what Austin, the real person here, the author of this DD, has just told us. Finally, the comment by Bruce Bartlett regarding the mismatched investment strategies between stocks and options is crucial in painting the picture of today's market. Now let's do a super brief walkthrough of the main parties within the DTC before opening this can of worms. So anything before this can of worms?
Let's do it, man.
Let's do it. Can of worms time. He's going to talk about three groups within the DTC: issuers, participants, and seed and co. Right? We can call them seed or concede.
Nobody else seems to want to talk about them, so
okay,
sure, let's do it.
Let's see. Issuers are companies that issue securities or stocks, while participants are the clearinghouses, brokers, and other financial institutions that can utilize those securities. Seed & Co. is a subsidiary of the DTC, which holds the share certificate. So Seed & Co., is it like a branch like the DTC or the NSCC, or is it slightly different?
The DTC refers to them as an enrollee.
Okay, so they're...
That's I can't find any, like I did a quick search on them. I don't want to get too far ahead of myself, but yeah, they're pretty much a ghost that nobody really wants to talk about. But they're so huge. Like Yeah, I'm spoiling myself, so go ahead.
Okay, we won't spoil it, but they're an enrollee. Participants have much more control over the securities that are deposited from the issuer. Even though the issuer created these shares, participants are in control when those shares hit the DTC's doorstep. The DTC transfers those shares to a holding account, Seed & Co., and the participant just has to ask, "May I have some pretty please with sugar on top?" What's going on here?
That's exactly right. So let's take GameStop. Let's just say GameStop and AMC and anybody else that's got a heavy short. And they are the people that can actually control the number of shares in circulation. So they've got, let's say GameStop's got 50 million shares, and they want some of their shares to be traded through the DTC. They can go to the DTC and say, hey, keep this on deposit so that when brokers come to you and they're trying to trade our shares, you have an account where you can go to and you can say, I'm going to take these shares. Right. So that's what they did. But what was apparent, and this is kind of explained in a little bit more detail, is the DTC had a very hard time letting those issuers have their shares back. Because by the time they gave them to the DTC, participants were already using them to trade. So if they went and said, okay, we want our shares back, now they've got to reverse a whole bunch of tricks. It wouldn't be that big of a deal if everything was done the right way. It wouldn't, because the share would go from GameStop to the DTC, and then it would go to the person that bought it. It wouldn't be that big of a deal. So that was just setting the stage here to let you know, like, these are the three people that are going to be talked about in the post, and this is how they relate to each other.
Okay, thank you for that context. Now, where's that can of worms? Everything was relatively calm after the crash of 1987 until we hit 2003. Deep breath together, right? 3, 2, 1. Okay. The DTC started receiving several requests from issuers to pull their securities from the DTC's depository. I don't think the DTC was prepared for this because they didn't have a written policy to address it, let alone an official rule. Here's the half-assed response from the DTC. DTC has stated, in its opinion, these issuers have no legal or beneficial interest in the securities they are requesting to be withdrawn from DTC. They have no power here. It turns out they did, right? So why did they not have a response in play? What do you think?
I don't think they expected him to ask for the securities back. I really don't, because they have rules and policies written out for, like, participants. If a brokerage, they want to get their securities out, they just submit a written request to the DTC, and the DTC will give them to the participant. But nobody, they didn't have something where they said, you signed this contract saying if you ever wanted to have your shares back, you would have to go through steps ABC. They didn't even have that. So just off the top of their head, they're like, you don't own them anymore. And that's basically what they're telling these people. You don't own them.
You don't own them anymore. And realizing the situation was heating up, the DTC proposed 2003-02. Wow, before they had multiple zeros. DTC's proposed rule change provides that upon receipt of a withdrawal request from an issuer, DTC will take the following steps. 1. DTC will issue an important notice notifying its participants of the receipt of the withdrawal request from the issuer and reminding participants that they can utilize DTC's withdrawal procedures if they wish to withdraw their securities from DTC. So this first one doesn't seem like it's anything. It's just giving them some official notice and a reminder. And then number 2,
notice.
Very important. And it notifying it. 2, DTC will process withdrawal requests were submitted by participants in the ordinary course of business, but will not effectuate withdrawals based upon a request from the issuer. It seems like number 1 doesn't do anything, but what does number 2 do? The effectuate withdrawals.
Number 2 is basically saying, number 1 just says, if you tell us that you want to get your shares out, we're just going to let our participants know that you want to get your shares out. We're not going to do anything. We're just going to tell the people that have your shares that you want them back. 2, they'll process withdrawal requests submitted by a participant. Okay, so again, nothing changed there. They're going to do that in the ordinary course of business, but it will not effectuate or do anything about withdrawal requests from an issuer. So So they didn't. So all of these people were saying we want our share. All these issuers were saying we want our shares back. The DTC just realized we don't have an official rule to reference to tell you that we can't do that. And so what they did was they proposed a rule saying now we have it in writing that you can't do that.
Yeah, they have.
That it didn't help the issuer at all.
So they're fuffing around. And this is, we'll read it in a second, but this is a sign for something more sinister. Honestly, they were better off without the new proposal, caught a typo. It became an even bigger deal when word got out about the proposed rule change. Naturally, it triggered a tsunami of comment letters against the DTC's proposal. There was obviously something going on to cause that level of concern. Why did so many issuers want their deposits back? Are you ready for this? Dun 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 dun. Anything to say before we're ready for this?
Nope. I'm just trying to fix that typo, but I'll do it later. Awesome. I'm trying to look at report requests that are coming for the post too.
Awesome. They're all good, right? This report is.
Yeah, people just saying like it's misinformation and stuff like that.
It rocks my socks. It makes me like nice and ready for the squeeze. As outlined in the DTC's opening remarks. Description. Recently, a number of issuers of securities have independently requested that DTC withdraw from the depository all securities issued by them. Footnote 4. As explained in further detail by many of the commenters opposing DTC's proposal, the issuers making these requests have alleged that their securities have been the target of manipulative short sellers. So this is from 2003, right?
This is almost 20 years ago. Yeah.
Almost 20 years ago, manipulative short sellers. What?
So basically like about 10 years, a little more than 10 years after the first sort of computer programs came out and started, again, they were just supposed to like make trading easier for people to begin. And then people realized, hey, we can do a lot more trading a lot quicker if we build our own programs. And yeah, you give that 10 years and now people are already finding like, this is going on a long time before this. But it started to be called out with the DTC at this point.
I think that with this bombshell, we're really ready for that Matt Damon to play you in the movie cameo. I've been watching a lot of Matt Damon recently. Watched Ocean's 11 because of DFV. I watched Ocean's 11. Haven't finished Good Will Hunting, but I'm almost done with that. Yeah, I can totally see what you mean by the resemblance there.
I've had a couple of people tell me something like that before too, which I love it. I love Matt Damon.
Matt Damon. Have my shares deposited in a clearing company to take advantage of their computerized trades just to get kicked to the curb with no way of getting my securities back, and then find out that the big participants at your fancy DTC party are literally short selling my shares without me knowing. Does this sound familiar, anyone? I don't know about y'all, but this is trust us with your shares BS is starting to sound like a major con. So 20 years ago, we saw evidence of this right away. Does this help our case with congressmen and moving forward, getting this in front of more important people?
I think it should. I mean, it's just more things that we can bullet point. But if anything, it helps just to know that this is the chances are that they're doing with these companies that aren't shorted either. Like the shares outstanding, when you see anything more than 100% shares in possession, like an institutional ownership thing, I think it was almost like 200%. This is why, because they're selling more shares on a trading platform than exist. And so that's what these people were trying to say is like, hey, you guys are short selling our securities and we want them back so that you're driving down the value of our company every time you sell our stock. We gave them to you so that you could trade, not so that you could short. So yeah, it was it's just more evidence that needs to be put in front of people that can do something about it. That's all. Let's
say that if you guys still don't understand how this relationship works, we have Mr. Mystic Man Moneybags here. And he comes to your small town, and it's kind of like J.G. Wentworth, right? 877 or whatever, the commercial where a guy comes to town and he's like, I would like to have all of your money now. And it'll be better for you than keeping it in a bank account because I know what to do with this money. I would like to buy some stocks, and then with that, I'll give you money in exchange. This is actually how scammers work in WhatsApp. So if you guys have ever received a message in WhatsApp that's like, contact me on WhatsApp, and they can even pretend to be me, this happens often, but you give them your money and they show you a small return, and then you're like, I'm hooked. Now you spend more money, and then they'll, if they're a scammer, take your money. But if they're a hedge fund, sorry, I just said the same thing twice. But if they're a hedge fund, they could end up taking your money and then go out and short with your money, right? It takes capital to do any kind of trades in the market, and they could end up doing practices that you didn't agree to, but all they promised you was to give you more money in exchange for the money that you give them.
That's right, and all they're asking for, like what they're hoping for is that you won't ask for those shares back or that money back.
Right. And that's, at the end of the day, starting to look like a big deja vu event. The DTC asked for feedback from all issuers and participants to gather a consensus before making a decision. Altogether, the DTC received 89 comment letters, a pretty big response. 47 of those letters opposed the rule change, while 35 were in favor. To save space, you're going to use smaller screenshots. Here is a few of the opposition comments. We're imagining they're going to be pretty similar to, who was the one that opposed one of these DTC rules? It
like
was
the 003.
Yeah.
The OOC 003, where he was like, I have 1,000 shares of GME. Is that who you're talking about?
Yes.
Yeah.
It's starting to feel like that.
It can come from people like that. It can come from the actual issuer themselves. It can come from private investor. But yeah, normally these things, like from what I was seeing on here, there's an archive where you can go to. I've got it linked in here, where you can go to and you can see, like, by year the number of proposals that are put out just within the DTC. And most of the time, people don't even really comment. Like they'll throw out a rule change and it'll be something like, we're going to add a small fee for doing transactions or something. People are like, okay, whatever. Sometimes you'll get a few people that'll throw some feedback in. This one had 89. Like, this is to everybody that had a significant role in this, or felt like they were victimized, came out. And the people that were throwing dirt at the DTC for doing this, the DTC needed people to say, it's like if they would have gone through this, and if they were to pass something like this and everybody was saying don't pass it, it would make them look guilty. So they had to have people on the other side, the participant side, come out and support them. And so it's almost like, yeah, I'm getting ahead of myself, but there were a lot of people that opposed this.
This is so exciting because we're kind of like watching a movie with the director here. Some people were asking if you wanted to read instead. Did you want to?
No, it's fine. You've got it on your screen. I'm reading on mine. That's fine. Keep reading.
Heck yeah. And let's see if we actually have
the DTC for doing it.
And check my audio. Let's see if we've gotten that 1,600 likes. No, 400 more for Austin. And then, you know what? I'll throw in something. I'll throw in a quick pull of the Glenfiddich. Are you a big a whiskey kind of guy?
Not really. No.
No.
It's hard for me to drink hard liquor. I'll drink beer every now and then, but.
Fair enough. We'll have to have a beer one of these days in person.
We will. We will.
So excited for that. Let's look at this. Dear Senator Lieberman, my firm represents Flight Safety Technologies, Inc., FST, whose shares are traded on the NAS, blah, 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 blah. We are writing to enlist your support of our request to the SEC to conduct an investigation into naked short selling of shares of small cap companies on the OTCBB. So that's from the SEC.gov. There's a lot of like suspicious stuff on the SEC.gov website, right? They even tell you how to do phantom shares. They told you before how the rehypothecation and like the shady stuff can work. It's basically like how to do all kinds of manipulation that we've already seen before that we haven't even enforced, like cracking down on.
That's the other thing with all of this is like, okay, I made this comment. I was like Corey's channel. I may have made it on yours too. What you learn in school is like you learn how people are committing fraud. And then when you're going through audit, you learn how to catch or detect that. But if you take it a step further, you're learning how to commit fraud. Because if you learn the audit procedures and you learn how to test for fraud, you also learn, like, if I can do things that aren't audited, then I can commit fraud and not get caught on an audit. So it's like the SEC, if the SEC is saying, hey, we're going to check these things and make sure you're doing everything right, how is that any different? It's like, it'd be like if you were trying to build a legal case against somebody and the counterparty to the lawsuit told you their plan of attack. Yeah, well, if you know that ahead of time, you can get out of it.
Yeah, that wouldn't make very much sense. So power hour is about to start in 4 minutes. What I'm going to do is I'm going to put a tiny GME in between us so that we can have that. And so I need to go to this tab real quick. So you'll see a quick blip for like 5 seconds. So what I actually did, you know what? There's a way to do this more intelligently. That's fine, actually. What I'm actually just going to do is pop in WeBull, like a tiny little monitor here. So one chart. So some people are asking how this actually relates at the end of the day to GME. I'm assuming that we don't want to spoil it, right?
It's GME is a blip on the entire, like, it's a P on the entire dinner plate of what's going on here. And because GameStop was so heavily shorted, this is just a way of like showing people nobody has any idea what or who owns the shares that you're supposed to own. And investing in GameStop, which I've done, and it's the only thing that I own outside of a small investment with like my 401, is to hedge against this malicious behavior.
Okay, so we're going to come around that realization in a little bit, but let's look at one other looky-loo here person who says, as an investor who has been continually burned by inefficient and poorly organized DTC as relates to naked short selling, I urge you to allow companies blah, 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 blah. So those are some lukewarm attempts to try and shout against the manipulative short selling. Here's one more. This rule should not be passed because by permitting the settlement of so-called short trades by traders not holding share certificates, the depository, the DTC, has shown itself to be incompetent to uphold the law and stop illegal naked short selling. If not complicit in such practices, and therefore what is all these typos?
Supposed to be companies, yeah.
Only protection from an attack on its stock by such criminal activity may be to withdraw unilaterally from the DTC settlement system. Oh, okay. If the SEC cannot prevent illegal short selling and is unable to police and regulate the DTC to make certain rules are being followed, it must allow companies whose shares are under attack to protect their investors by withdrawing those shares from the system, the DTC, where they are vulnerable to such attacks. So essentially, get out of the DTC, get out of the money cartel.
That's it. Okay. That's it. Because when you give your shares to the DTC, they are not in your control anymore, and you don't know that these things are going to happen. It'd be like, okay, rent a center. Like you have your car, and you go to rent a center or rent a car.
Right.
And you go and they're like, okay, where are you going? Do you need a truck? Do you need a car? Blah, 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 whatever. And you don't tell them that you're going to a rally, like a rally car event, where you're going to be bumping into other cars, and you bring it back and it's all beat up. And they're like, I didn't know you were going to do this. That's what they're complaining about here. Like, we gave you our shares so that you could conduct trades, not so you could drive our stock price down on behalf of your participants.
That's a really good way to put it. I think that is, where's my money man here? Mr. Money Man, who wants your money, but he's not going to tell you how exactly he's going to make more money. And you are not okay with the ways that he is basically punching puppies to get you a little bit more money on top of your initial investment. Okay, here are a few in favor. All right, so we have well, look at the other side as well. UBS Warburg LLC believes that the proposed rule change is consistent with the security industry's initiative towards straight through processing and decertification. Anything to say about decertification?
Decertification is let's get 100%. Let's get rid of 100% rid of physical shares.
Okay.
That's blatant. That's them blatantly come out saying, it's much better for us to do this on a platform where we can just put a digital number on someone's screen and tell them that's there, because all of these things, they say like, oh, it's quicker and it's less expensive for the DTC to hold it because they have to pay fees for the physical shares they have and blah, blah, blah. And it's not. It's in reality, they have much greater flexibility with committing frauds if they are the ones that say we can control how many shares are out there versus the actual physical pile of shares that we have to work with. And straight through processing is just like from person A to person B is just conducting those trades a lot quicker.
Okay. Number 2, we have this person over here, Merrill Lynch. Actively supports industry efforts to achieve straight-through processing, STP. Already sounds bad. STPs, you don't want to get an STP from Merrill Lynch. The clearance and settlement of U.S. securities. A significant building block of this effort is dematerialization, eliminating the issuance, use, transfer, and retention of physical securities. Is this kind of like them saying, yeah, we need this because sometimes the market is slow in some places and fast in others, and we need to make sure that this asynchronous activity can work?
What it's saying is, like, if this proposal isn't approved, we have to start accounting for all the shares that we've sold that don't exist. And if those people want their shares back, turns out we've sold more than they gave us, and we don't have a way to give them back. That's what the big thing about the naked shorting was. So it's like it wouldn't be that big of a deal if the physical shares were traded the way that they should have been traded. They shouldn't have had an issue. And in which case, like, all these people started realizing this was going on. They went to the DTC to try and get their shares back. And the DTC is like, well, our participants are doing things with them. We don't really know what they're doing, but no, we can't give you your shares back. That's all they said.
3. The industry goal to, who is this from? Mr. Jonathan
This is
G.
Royal Bank of Canada.
Oh, so RBC.
Also board members of BlackRock.
So board members of BlackRock and RBC, the industry goal is to achieve STP and ultimately migrate to T+1 settlement. In a connection with a study to determine obstacles to STP, a major effort was made to analyze all reasons by retail customers to hold physical certificates and to determine appropriate alternatives. The answer was that the direct registration system, the DRS, was established to enable owners to be held directly on the books of the issuer in lieu of receiving a physical certificate. DRS provided many of the benefits of STP while giving share owners the inconvenience of holding certificates without brokerage intermediary.
That's just saying basically the same exact thing we were talking about. Like, they prefer this system, which is an STP system, which says if you buy a share, it's going to be accounted for on the actual issuer's book, and you will be like, you have the issuer and they have all of these shares that exist, and then we're just going to put your name on the issuer's list of shareholders instead of like giving you a physical share. But it allows for the same thing to happen.
So so since we're considering the counter argument, have you considered that this is not so this seems a lot like filibustering and manipulation and just like saying one thing but meaning another. Do you see any merit in this argument?
Yeah, and I get down like the next sentence below that, to the full list of there, and then where I say I realize there's advantage to paperless securities. Those advantages are this is a much quicker system. Like when it's used the right way, I don't want to be that stock trader or that financial institution at the end of the day that has to go and do like manual entries in a ledger for 2 hours. Nobody wants to do that. So there's this like the 90% of this system is great. Like if you were to implement this and you could be honest about it, it would take care of a lot of problems. You could trade in real time. You could do like same day settlements. You could, you would leave it to it's like blockchain where it's not just one person keeping a ledger. Like now the issuers have their own ledgers. So you'd have to make sure that everybody matched, to keep each other accountable. Like there are so many advantages to this, but it's like, what's his name? Michael Sandow, which is the guy that said, if we can't trust the DTC to protect our interests, then we need to pull our shares out. And the problem is the 10% bad side of this is bad.
The 10% bad side is bad. You heard it here from Austin Tobit. I think we're getting real close to 1600. I'll pay it in advance. I don't have a glass, so cheers to you.
There you go. Bottoms up.
Bottoms up. Andreas Antoniou, I'm going to read out his good question. it's a quick recap. He says, so GME was a small P turned into a black hole due because of small float, which when shorted heavily increases the risk should a part of the float, e.g. retail investors decide to hold to death. So some people basically go down with the ship, doesn't matter where they go. What do you think about that? Never sell, essentially.
I don't really understand the question.
Essentially, it's worded in a strange way, but essentially, should some selfless apes hold until the end, even if it means that they'll miss the squeeze entirely?
The way that I see it, you can't miss the squeeze. And it's just the way that the market should work is if you've shorted over 100%, the only way that you can pay that back is if the company issues more shares, and then you buy those and then give them back. So when they have to buy all those shares back, it's not going to be like this. You go up, you have a squeeze, and then it goes down. Like there's no downside because the demand is still, we need more shares.
Okay.
So like this can only be covered if I sell all of my shares during the squeeze, you sell all of your shares, everybody else sells all of their shares. That's the only way that they'd be able to cover it.
Andreas, hopefully that answers your question. Here's the full list if you want to dig down of your own. So look at this man, not only digging through the supporting evidence, but making plenty of time for the counter evidence as well, and the different sides that there are for and against this manipulative practice. They realize that there are advantages to paperless securities transfers. However, it is exactly what Michael Sundow said in his comment letter above. We simply cannot trust the DTC to protect our interests when we don't have physical control of our assets. Basically, I want my own hands on the steering wheel. I like your computer driving the car for me, but I'm the one who's going to have a concussion if the car crashes.
Perfect. Yeah.
Several other participants, including Edward Jones, Ameritrade, Citibank, and Prudential, overwhelmingly favored this proposal. How can someone not acknowledge that the absence of physical shares only makes it easier for these people to manipulate the market? This rule change would allow these participants to continue doing this because it's extremely profitable to sell shares that don't exist or have been collateralized. Furthermore, it is a win-win for them because it forces issuers to keep their deposits in the holding account of the DTC. Anything to say about it here?
I think we've already said it.
Okay.
That's pretty much it.
Ever heard of fractional reserve banking system? Sounds a lot like what the stock market has just become. Coming back to the fractional reserve banking system.
I mean, think about it. It's just a model of that. Like, you have a counterparty, you have the main bank that holds the money, and they'll lend out 90% of it, but they keep like a big balance sheet, because that bank they lent it to then owes them, and then that bank B. It's what we charted out last time we were on.
Let's draw this again. So we have Bank A that has 10% of their funds here, and they are going to lend it out. They have 10%. They lend out everything else to Bank B, right?
Yeah.
So they have 10% and they lend out everything that they have to Bank B. Now Bank B has 90% of Bank A's assets. However, this liability that Bank B owes the rest of Bank A's assets, the 90% of which makes it seem like Bank A is whole.
That's right. And on their balance sheet, Bank A says, like, I have a receivable from Bank B. They owe me, let's say if we started with $100
right,
and I lent out 90, then they owe me $90. And then Bank B will take, let's just say $80 of that 90 and lend it to Bank C. When you total up everybody's balance sheet, you have 100 plus 90 plus 80, which is 270. But there's only $100 in existence.
Right.
So Bank A can't get their money back unless they go to Bank B. And Bank B can't get their money back unless they go to Bank C. So you have this domino effect of rehypothecation. And that's exactly what's happening here.
If you guys are waiting for that rehypothecation section of the DD, we're finally coming around to it. I think that was well worth the other important bedrock that we also had in terms of context. We have a question from Zachary Justins. Could they not just buy, say, 25% of the shares, give them back, and repeat until they've bought back whatever percent they've shorted?
How would they repeat it?
Well, they could buy back.
They
could buy back 25%. So let me think about
from who?
people who might not be us, might not be diamond apes, right? Bears in the market who paper hand in the morning.
If they do, and they buy back 25% of a short position, it has to go like that. They're not just going to buy one share and then wait 5 minutes and buy another share, or buy 100 shares and buy another. Like, they get margin called, and this is what the DTC is proposing now, is having to cover within an hour, which is 801. They'll have to go in and buy all of this. So they go in and they have to buy 100% of their position in an hour. If let's say that they were, let's take this example a step further. So if you cover 25%, and if I bought shares from you and I cover 25%, what am I going to go back to you and buy another 25%? Like, I have to buy those from somebody else. And when you're talking about this much volume that's being shorted, you're going to send the price of the stock up like crazy. So that next 25% that you have to buy is going to be an even higher price.
So currently we're talking about two different mechanics here. Is that A and B and C are three different people that have recursively been shorted the same stock. C currently is the only person that actually owns the stock. This is a covered short here, but the hedge funds borrowed it from B and then gave it and borrowed it from A, and now in order to pay everybody back, they need to buy it from C, then give it back to B, and then buy it immediately from B and give it back to A. That's the recursive covering that for covered shorts. However, as I've written up here, a great portion of the shorts that exist are naked. So how do we even find those shares, especially with the amount of people that are going to be diamond handing in the near future? This is hopefully an explanation to your question that Austin has also answered. If you want to recursively cover, that's going to cause ridiculous price action upward. And with ridiculous price action upward, even the most paper handies Portnoys in the world are going to ask, hey, if the price is rising, can't I hold? Can't I hold now, right? If they start to see the legitimacy, and actually, if you guys are supporting the stream and sending Atobit's message into the universe, people will also be able to jump on this question and say, well, I don't have to sell if the price continues going upward. I get to set my own price at the very end.
Yeah, sorry, I was reading through somebody had commented on the post. I'll tell you what. Think about it this way. Like, think about rehypothecation, like, because this is an actual example that happens with banks. Okay, and this is kind of what I'm diving into in part 2, right? If I want to go and get a mortgage, I want to go to the bank and I say I have X number of dollars to back my loan, and I have a 5% down payment. You give me the money so I can buy this house. And let's say I go to U.S. Bank, and they say, okay, great, we'll give you the money for it. And my house is now collateral on my loan. U.S. Bank also wants some more money. So they'll go to Wells Fargo and say, give us a loan. And as collateral, we're going to put up my house. It's not even their house. I haven't even defaulted on anything. But they will use that as collateral in a loan. That's rehypothecation. That's using the collateral of your client that's not even yours to back your promises to pay. And that's how the system is working.
And that's how it worked back in 2008 as well. So this is the kind of shenanigans, but with a completely new, well, not even that new, but it's a different asset than the one that was the major one before. Okay, so now that I'm done with all those pencil drawings, let's take a look at more proof of market manipulation. Let's fact check the claims from the opposition letters above. They're going to only report a few at a time period they discussed, about 2003-ish. So this is just to validate their claims that some sketchy stuff is going on. UBS Securities, page 559, short sale violation, 3/30, 1999, 535, over reporting of short interest positions. And the list goes onward, right? So you were compiling these yourself. How long does it take to find one? Like, basically, you can't just command F and find these things, right?
I did that with this. Okay. Yeah, because I know, like, at this point, at this point, like I know what to look for when I'm looking for a short sale or an indicator of a short sale. And sometimes they'll come out and say it, like Citadel has this. Citadel has fines where it'll explicitly say naked shorting. And it just because FINRA doesn't fine you or cite you for naked shorting doesn't mean you're not committing it. But when you have this many issues with shorts, and this was just in like the 2000 to 2003 range, so that I could say, you know, this was in the same time period, because I didn't want anybody to make that argument that like I was posting something outside of that time frame. So what you have here is like you can just pull up any of those documents and Control F and then go to the bottom, which is like if it says it results 1 out of 179, which I think was Merrill Lynch or somebody. And you go to the bottom, you go to 179 out of 179, and you just click up. It'll show you like all of them, like 1999, 1998, 1999, 2000, and so yeah, the list goes on and on. And when people have short sale violations, it's not like they have them for a time frame and then they fix the problem. It's like their entire FINRA report is littered with. They've got some this year, they've got some this year, this year.
Well, thank you so much for traveling through that paperwork. Once again, people are talking about your creds, and they say there's a solid as can be masters in accounting, giving us their graduate degree level of looking at these, looking at this data. Ironically, Austin picked these 3 because they were the first going down the line. He's not sure how to be any more objective about this. Their entire FINRA report is littered with short sale violations. Before anyone asks, how do you know that they aren't all like that? The question is, he checked. If you get caught for a short sale violation, chances are you will always get caught for short sale violations. Why? Because it's more profitable to do it and get caught than it is to fix the problem. It's kind of like murder. They're going out and murdering, but the punishment for murder is so small that they just might as well murder more instead of finding out better ways to murder well.
Yeah, or it's like a DUI, right? If you get caught for a DUI, first time you get a hand slap or something, and then the second time you do a little bit of time in jail, but when you get back out, you go right back to doing it. But imagine just getting. You know, if you get a DUI, they take you to jail and they basically let you sleep it off and then give you a meal, you know, and then the next day you go right back out and you do it again. It's like eventually it's like, well, at least I've got a place to put my head at night, you know? So it just keeps happening on and on again.
That was a bleak interpretation, but we are not here to talk. I also agree with your interpretation, but we're not here to talk. We're talking about silly hedge funds getting in trouble. Several comment letters asked the DTC to investigate the claims of naked shorting before coming to a decision on the proposal. I never saw a document where they followed up on those requests. Now, you want to know the worst part? Oh man, you're setting this up so well. I can totally hear this in your voice. Holy. Okay, it is therefore ordered, pursuant to section 19b2 of the Act, that the proposed rule change be and hereby is approved. The DTC is passing this rule change. We had talked about this rule change from like 20 minutes ago. Let's give the apes a chance to remember what that is. What is this rule change here in the simplest ape terms?
Nothing. So these people wanted their shares back because they gave to the DTC, and the DTC didn't have a written rule for like that said that they couldn't give those shares back. So when all these people wanted to get their shares back, they said, hey, your participants are short selling the shares we gave you in good faith to conduct our trades. And your participants are short selling them. We want those shares back. A lot of the responses in the comment letters were saying, like, you don't have a rule that says we can't get our shares back. And so that's what the DTC did. They proposed a rule just to make it so that, see, we have an official rule that says you can't get your shares back.
Okay.
Before they implemented that, they asked for a bunch of feedback. They asked all these issuers and these participants, should we pass this? And I don't even think they really cared. They just went ahead and approved it anyway.
So 20 years ago, we had, hey, maybe we shouldn't do this. because it is wrong and it makes you feel like you don't have control over your own assets. It's a house of cards that is going to start its base foundation here in 2003, and the DTC did not care.
Sorry, I had somebody reported a post and just said heart and then my name, like they reported the post, and just it's funny.
That is the system itself working. This post stole my heart. They not only prevented the issuers from removing their deposits, but they also turned a blind eye to participants' manipulative short selling. Even when there's public evidence of them doing so, those companies were being attacked with shares they put in the DTC by institutions they can't even identify. So let's take another quick breath. Ready? 3, 2, 1.
Okay.
And recap. The DTC started using a computerized ledger and was very successful through the 80s. This evolved into trading systems that were also computerized, but not as sophisticated as they hoped. They also played a major part in the 1987 crash, along with severely desynchronized derivatives trading. So this is the prequel to the movie that we're currently watching. In 2003, the DTC denied issuers the right to withdraw their deposits because those securities were in the control of participants instead. When issuer A deposits stock into the DTC and participant B shorts those shares into the market, that's a form of rehypothecation. This is what so many issuers were trying to express in their comment letters. In addition, it hurt their company by driving down its value. They felt robbed because the DTC was blatantly allowing the participants to do this and refused to give them back their shares. It was critically important for Austin to paint that background. And I have to say, well painted. This is a Michelangelo of a DD, because you are not only working overtime to find the right sources, double check them, get multiple eyeballs on them, but you also are making it easy, narratively simple to digest. And I think that's a skill by like a whole team of people when it comes to building out like news articles like this.
Appreciate it. Thanks.
Now then, remember when I mentioned the DTC's enrollee, Seed & Co? Now we're finally getting into it. They'll admit, Austin will admit that he did not think that they were relevant. He focused so much on the DTC that he didn't think to check their enrollee, which he did. You don't really own your securities. Can blockchains fix that? This is a article from AmericanBanker.com. And Austin has highlighted, it is not owned by the ostensible owners who, by virtue of having purchased shares in this or that company, are led to believe they actually own the shares. Technically, all they own are IOUs. The true ownership lies elsewhere. Nearly all publicly traded equities and majority of bonds are owned by a little-known partnership, Seed & Co., which is a nominee of the Depository Trust Corporation, depository that holds securities, blah, blah, blah. For each security, Seed & Co. owns a master certificate known as a global security, which never leaves the vault. Transactions are recorded as debits and credits to DTC members' securities accounts, but the registered owner of the securities, Seed & Co., remains the same. So this sounds a lot like contract for differencing, but I'm imagining that there's a slight nuance in that the trades actually do happen, but they are all happening within. Do they? I'm just trying to figure out what this is saying. Is this the same as contract for differencing?
I don't know. I'm not sure what contract for differencing is. But what this is saying is like, it goes back to that phone example, right? I have my phone, and I'm going to give this to Seed & Co. And then if I really own that, maybe I paid money for it. But then you come to me and you say, hey man, I want that. And I'm going to say, okay, I'll sell it to you for more than I paid for it. You know, and I give you the IOU for it. And all it takes is for me to then turn around and say, you know what, I can make some more money if I just make another IOU and sell it to Professor Meatball. And then you do the same thing, and then Professor Meatball does the same thing, and that's what these financial institutions have done. And so they create more shares or more IOUs than exist for that global security. Well, I guess the fact that you have so many hands touching and exchanging these before it even gets to the person that bought it is very concerning.
So for CFD, just so how everyone understands, this is how your crypto is bought on Robinhood and WeBull. Right? They don't actually go out and buy the crypto. They just pretend like they did, and then they'll do the difference when you decide to sell. right? They'll remember where you bought it, and then they'll just pretend like you have it. And then when it's time for you to sell, it's mathematically the same. So at the end of the day, all that it takes away from you is the democratic process of you being able to say, hey, I have actually made it. I want to have buying pressure on this stock. And that was what got a lot of people angry when Robinhood had a scandal that supposedly they also were engaging in CFD for GME and other stocks at the time. So this is a master certificate in their vault, which never leaves. Instead, they issue an IOU for that master certificate. People in the chat are already saying, this sounds fraudulent. Is this a blatantly illegal tactic?
They did it in 2003. They've done it before 2003. They did it in 2008. They did it they have never not done it.
They have never not done it.
They have never not done it. Yeah.
Well, this is just a better insight into the way the world works in that sense. Is it unfair? Well, hopefully that we are going to have some regulators take a look into this soon. Austin says, didn't we just finish talking about why this is a major flaw in our system? And that was almost 20 years ago. Here comes the Mind-F. Part 8, Illegal Naked Shorting Series. Who or what is seed, and what role does seed play in the trading of stock? Wow, we have brand new terms today. We have seeds and we have Justins. If you're watching the live chat, we have a person who is riling up the discourse here. And instead of Greg's, I think we have Justin's now. When you buy a stock, you are actually purchasing a security that affords certain entitlement rights related to registered stock, which actual owners hold. So this is if you buy it from a DTC related broker. Is that right?
Yeah, who's not a member of the DTC?
Fair enough. So this is...
I mean, keep going.
Well, let's see. Seed is a subsidiary of the DTC, which is a subsidiary of the DTCC, and the DTCC is a private company owned by elite Wall Street firms and money center banks. Effectively, hold on, wait. If you need background or refresher on the DTC, click on this link. Effectively, elite Wall Street firms and money center banks, not institutions and individual investors, own almost all of the registered shares of publicly traded companies in the US. While you may think you are buying registered stock, you're actually buying a financial derivative related to that stock. Effectively, you are buying a financial derivative from brokers of a financial derivative they hold from seed that is just a digital entry in your DTC account. This sounds exactly the contract for referencing. So they're pretending like you have the share.
The only point of giving someone a share is so that they can have a voice. And that's what this is like. The problem never started off saying, the way that this article is written is like, when you buy a stock, you're actually purchasing a security that affords you certain entitlement rights. Like you'll receive a dividend for having stocks. You'll be able to vote in stockholder meetings. And for people that have enough of stock, they actually have like a significant influence in making directions or decisions in the company. But when it comes down to the average person, this shouldn't have mattered. The problem is they did this so many times that there are more shares than actually exist for people. And there's no blockchain. This is not a decentralized ledger system. So everything is reconciled in the DTC, which is scary. Imagine if Bitcoin or, I mean, heck, Dogecoin now even. Imagine if any of those were maintained by one person. Would you trust any of it? I wouldn't. I wouldn't trust somebody to say, and by the way, seed is completely dark. There are no financial statements on it.
This gets
They could legit. Do you remember? Have you ever seen Game of Thrones?
Yeah, love Game of Thrones.
Okay. Do you remember Xarxes or whatever his name was? He was like trying to marry Daenerys in one of the earlier, and he says, "This is the key to the entire kingdom." On his thing, and they opened the vault and it was empty.
Yeah.
Like, how do you know that's not? Do they really have these shares? I don't know. If the entire stock market was supposedly held by one little company you've never heard of, I think they should have a financial report about it.
Wow. This is the best Game of Thrones analogy. Apes, open your third eye. I'm still reeling from this. I'm getting riled up. 5,200 of you in here. If we can get this video to 2,500 likes for 8-bit, and then we're 705 subscribers away from 79,000. If we can get to this by the end of this live stream, That's about 700 subscribers away. I'm gonna buy another $1,000 of GME and AMC. This is huge. This is the way the financial system works. An entire country club of people getting their rocks off with saying, hey, you can have a little bit of this share, but actually pretending like you hold it.
Yeah. Yeah.
What? So this hurts my perception of the entire market. Well, in that sense, do we actually change the price of the stock with our retail votes, the democratic system? Are we actually changing it?
That's the question that's the whole. How much of these, and when you have something like Citadel where you've got this high frequency trading system, if you know that ultimately everything is going to be rerouted into this dark hole at the DTC, who's keeping you accountable from doing anything? Who's to say you don't own that share, you can't make that transaction?
Holy moly.
Yeah.
Okay. I'm almost done putting my brain back into my skull. Now, do you want to know what the best part is? So Austin says they found the list of all DTC participants that are responsible for this mess. We have to run through this. He's got your name, number, and he's coming for all of you. All of you, to be continued part 2. Dude, I have to know what is in part 2. This is ridiculous. And you found it all. Where was the source from? How did you find this?
The DTC.
Oh my God.
Idiots, right?
Oh.
So anyway, 15 pages.
15
of all of
pages.
All of everybody. You see Citadel there. You see Credit Suisse. Everybody. By the way, I was pouring through Credit Suisse. I think they're in some hot water. So they have an extremely leveraged position. This is also part 2 here, so giving a little breadcrumb. So this is all basically routing up from here. Now you know the system. Now you know how it works. You know that basically everything is kind of being traded on someone's word. And the DTC has all of these participants. This is a list of all of those participants. I've just laid out, all of these cases where issuers were saying, we don't want anything to do with this because they're selling our short, or they're short selling our shares. We have no control. And it all comes down to a 15-page document of a bunch of names. And so when I started looking into some of these names, and this is when I messaged you this morning and I said, hey, basically I've got this whole post, but I'm starting to look into more of these big banks right now.
Right.
And Credit Suisse. Credit Suisse. They have, I think it was like 400 billion. And over half of that was basically encumbered, meaning the money that they are going to be receiving has to automatically be paid out to the person that they owe money to. And that's just one daisy chain. So it was like there was 150 billion, to be on the safe side, I'm going to say like 150 billion. 150 billion that was covering a liability. So they had to receive 150 from another person before that 150 could go out. Their total exposure, like their rainy day fund, is less than 100 billion.
Oh.
Yeah. They have a rainy day fund where they have like cash that's set aside in the event of something happening. So it's like a bank, right? A bank will only have X number of dollars on hand, but they have all of these liabilities. If somebody came in and they wanted to cash out all at one time, they couldn't. They'd have to request something from headquarters, and then headquarters would be like, we don't have that much money. We got to go to the Fed, or we got to go somewhere else. That's what is literally all these hedge funds are like that right now. So, I mean, pick a name in here, Bank of America. I think somebody sent me something on Instagram, which, by the way, appreciate the shout out for that too. Did a bunch of orders the other day.
Let's add it really back in. So if you want to support 8-bit, the easiest way is to support a small business. It's Good Bud on Instagram. So let me shout it out again. It's Good Bud.
Okay, here it is right here. Bank of America closed all of their locations today at 2 p.m. and rushed out all of their employees. That's 2 hours after the trial verdict was announced. I don't know what this trial verdict is. This is literally something that somebody linked to me. Last week, they sold $15 billion in bonds, and last night, their board voted to give all board members significant bonuses. I think a lot of people at Bank of America is going to be the first bank to go upside down with the market collapsing. They own Merrill Lynch, who has over-leveraged all of their investment positions, which Merrill has just been, I just showed you, Merrill was getting fined for short sale violations.
Right.
I Googled Credit Suisse earlier. Apparently, they're in more hot water. Like, there's more trouble brewing for them. And it's recent. Oh, there's something else too. Credit Suisse's prime unit risk chief had been Archegos' salesman.
Oh, shoot.
Man, I'm telling you.
That's a little too perfect. If you guys aren't aware, Archegos was the first of possibly many to come margin calls that happened 2.5 weeks ago. Man, time's flying.
Here's something from Yahoo Finance 14 hours ago. Credit Suisse's pain isn't likely to end with first quarter woes. So that's what I'm telling you. I put my head down in a book for 20 hours, and then I pull back up, and the media is covering exactly what the stuff that I've been looking at. So it's not just me. It's not just me saying it's like this stuff is everywhere, and that's what the House of Cards 2 is going to be, is like getting more into that daisy chain of like just how over leveraged are these people. Now that you know how the system works, you'll see just how broken that system is.
I think Matthew Salinas is putting it well, and we even covered this when we talked about Congressman Ro Khanna. So we're not going to let us off the hook yet. We need to talk about next steps for Ro Khanna. In fact, we already had a pretty good graphic created for the 6 bullet points. Honestly, if we want to get something in front of him ASAP, we might as well send that. But when he was here, we talked about the SEC taking fines as basically bribes. Like, I can't wait for you to break the law again, because when you do, I'm just going to take your fine, which is too small to actually deter you from doing the crime again, but definitely enough to support me, the guy who's getting a kickback, the SEC here. So with Gary Gensler on the throne, you had a skepticism of the SEC before. What do you think about Gary Gensler? Are we having a better chance of the SEC actually coming in if we know we can't trust the DTC?
I haven't done any look. I haven't researched anything on Gary Gensler. I would love it but until I start seeing like people doing stuff about it, like I just don't. Well, I don't have a lot of faith in it.
That's fine. What about part 2? Do we have solutions in part 2?
I think decentralizing the something has to be done to start changing the way the DTC is accounting for this stuff. Okay. Because I don't think a private company should have the power to hold master certificates for all of the publicly traded companies. That just seems really, really sketchy. So maybe decentralizing this whole thing is a good place to start, you know?
And that's what, and this is not a moonshot. We have heard these proposals on the congressional floor like months ago, if not years ago. People talking about crypto and the blockchain being able to utilize at least a piece of the stock market. In fact, this crypto and SEC regulations. There was that coin, always eludes me, starts with an I, but that coin has already in that liminal space between SEC regulations and the crypto world. So it's possible. But we will likely have to take at least one step at a time. They wanted to go from T+2 to T+0 or real time, but everybody basically agrees it needs to go through T+1 to begin with, even though logically it doesn't make sense, but compromises do have to be made. So in that sense, let's break it down one more time. How about we just scroll through this DD so that people have the clearest breakdown possible. I'm going to the very top until I get to your too long didn't read. Wow, what a DD. Hours of work put in, lots of sleepless nights from Mr. Austin Tobit, the person we're interviewing right now. How about you lead us through? What should we cover?
Okay, so up at the very top, starting off with the DTC.
Yes.
So the three, and I didn't even get into the NSD and the FICC. But the part that's covered in this post is the DPC, and they are responsible for, they're a clearinghouse for stocks exclusively. Now they were created in the 1970s, and the need for them came from this need for like a centralized clearinghouse. And as soon as they were able to start using a computer to keep a ledger for that, it made it so that these trades could be done a lot quicker and it could be done a lot easier. And that opened up the door for them to just say, okay, we don't really have to even trade the share anymore. We can just trade the number. Like, okay, this person has 10, and then we'll stop at the end of the day. We'll take account everybody that has what they have, and then we'll do the ledger that way. So it moved it from a physical share ledger to a virtual ledger, if you will.
Okay.
So it's fine and dandy, but it opened up the opportunity for a lot of naked short selling, or even just like any sort of stock manipulation that didn't have to like have the actual physical share in order to validate or verify a trade. And the problem was the buildup in the 80s, that was done a lot. And they started to build these computers that could also trade for them and do large volume trades at a very high pace. So it wasn't like a high frequency trading tool, but it was not compared to today, but it was a much higher trade volume than they'd ever seen before. And so that led to the crash in 1987. These played a very big role in it, along with the imbalance or the desynchronization between a physical asset and then the derivative on that asset. There were a bunch of other issues there, like illiquidity and trade budget deficits. There's a lot of things going on in the economy, but when the first domino fell, this just completely amplified it, because the trading program recognized that there was a sale going on, and it was a much quicker drop, a quicker sale than it was, I guess, programmed to be able to account for. So instead of going in and buying that low, it kept triggering more sales. And then the people that had built those machines didn't realize that's what it was doing. They were still hopeful that it would, buy that back up. And so they continued to sell the underlying asset, like the physical asset, while the machine was selling futures. They were selling the underlying asset, and it just tanked everything to the point where the computer would not turn back around and start buying everything back. So that's just like kind of the introduction into how the computerized trading program paved the way for what we have now with like Citadel. And 2 points to note there. We can go all the way down to the part where I talk about the DTC.
Okay. So
the highest level overview there is the modern tools that we have, and these hedge funds like Citadel have that they're trading with, are based off of the technologies that were here in the 80s. And today we would see an action like the 1987 crash as like a little blip on the radar, because the pool is so much bigger. And we were talking earlier about like the pond. Well, that's a really thin pond compared to today, which is like an ocean. It's just deep, deep, deep. So they didn't really like fix that problem. They just found a way to like be able to better program those algorithms, because there's much more control now than there was back in the day. So the two takeaways there are the trading platforms are still the same. They're just more advanced, and the over leveraging with the derivatives and the shares, or over leveraging of derivatives really is even worse than it was back then. And so taking that and then giving the walkthrough of the DTC, you have the three groups that I talk about here are issuers, participants, and seed and company. Issuers are people that issue stock, so the issuing shares of a public company. And then the participants are like your brokers. And so both of them work with the DTC, and the DTC just makes sure everything goes back and forth the way it's supposed to. At least it did back in the day. It was that's what the intent was. But as soon as there was an opportunity for them to start making money and go to where the money was, they started to favor the people with money. That's just the way the world works. So these participants have much more control over the securities that an issuer puts into the DTC. Somebody that's issuing a share of stock will go to the DTC. They'll say, hey, here's my share. I'm giving this to you in good faith that you will be able to sell it and transact it the way that I would do, but you have the systems to do it much quicker. And the participants are supposed to take that and say, my guy is offering to buy your stock. Well, that all happens through the DTC. So up until 2003, everything was relatively quiet, recovering after that. The 90s were great. You had this boom coming in, especially with the dot-coms, like the build of the dot-coms. And then in 2003, a bunch of people started to notice some fishy stuff going on with their shares in the DTC. A bunch of people meaning the issuers. And so the issuers went to the DTC. They said, hey, we want our shares back. And the reason they wanted them back is because they were alleging that the participants of the DTC, the brokers, were naked short selling their shares. And so this is like saying, it was their way of saying, we gave you these shares in good faith so that you could conduct this transaction. And instead, you're letting your participants short our company, which is driving down the value of our company. So if we can't trust you to do your job, give us our shares back. And because the DTC didn't have a written rule to say we can't give you your shares back, they made one. And that's exactly what the rule said. We can't give you your shares back, but we'll let our participants withdraw, but we won't let you withdraw. And so that ticked a bunch of people off, and they submitted a bunch of letters to the DTC saying, we simply don't want this. We don't want this to happen. If you're going to take our consideration in, please do an investigation into this. If you don't deny the rule or the proposal, at least look into this that's going on. And the DTC I never saw a follow-up letter to any of that. I never saw them even care about like the fact that because I'm pretty sure that they knew what was going on with their participants. And so obviously they passed that ruling, and it just favored the participant, who all of the participants that were advocating for it are advocating for this dematerialized or decertified method of trading, where they don't even need the physical shares anymore. And so that's where Seed & Company comes in. You gonna say something?
No, I was going to say that it's very similar to a bad online course that you want a refund policy on, right? And this online course is trying to teach you how to trade, and then you give money to them. They teach you how to do a couple of times, but then it turns out they're doing some pretty darn dangerous, risky business that hurts companies. You want a refund from them, and now they start saying, well, we don't have a refund policy. Let's just create one right now. You can't have if you're not satisfied, then you have to have this requirement and this requirement, basically writing the rules down themselves. And now we are playing with a resolution from 20 years ago that is really starting to catch up. The same angry people, I wonder if they're paying attention to the... have you tried to reach out to any of the people that wrote those letters that are against short selling?
No, I haven't. I just honestly found these... I found the DTC thing a couple of days ago when I said that I would have it posted the next day. And I'm sorry, I was just laughing here. Somebody reported this. They said, conspiracy theory, nothing to do with Jimmy, QAnon BS, how embarrassing. And someone else said, LOL, they're reporting my post saying this. They said, LOL, everyone in this subreddit is poor. Someone said, I don't even think I quoted this in the DD, but I said, in quotes, shares that trade millions per day aren't done in paper, ? Conspiracy, end of quotation. And then they said, effing moron.
Oh, man.
Somebody said, please take this zeitgeist tier BS off this sub.
Oh,
Imagine if you put all this effort into something not completely delusional. Oh, I love it. Okay. Yeah, but it's like getting a refund for a bad course because you don't think that you're getting any value out of it, and or even if they promise that you're going to cover this stuff, you're going to learn about stuff in this course, and then they don't do any of that.
Mm-hmm.
Or it's like a course like if you're supposed to take the course and you're supposed to be there like 3 days a week, and the professor only shows up once. You're promised something that they're not fulfilling, and you want your money back, and then they say, well, we don't really have a written rule that says we can give you your money back. And you say, well, you don't have a rule that says you don't. And so then they go behind a closed door real quick. They write something down on a piece of paper, and they come back out and say, yes, we do. And that's exactly what just happened.
Oh, man. Okay.
So,
well, I'll do another poll to say, fantastic DD. Thank you for pulling it together for us. I do have the 6 bullet points from a graphic designer that we have been in talks with for the kind of change that we would like to send in a nice graphic, right, to these congressmen who are probably tired of seeing non-pretty versions of these graphics. Here it is. I'm going to share it with him so that he can see it. But now that we've taken a look, you can still see it, right?
Yeah, I can.
Okay, 2,500 likes. Thank you for that. Getting the message out. People are saying that your post is on our popular now, so congrats. We finally got to 78,420 in honor of 420 yesterday. I'm sure you had a good day. Well, how was your 420, man?
It was great, man. I've got a bunch of CBD, and it keeps me from pulling my hair out.
Nice.
So it was awesome. It was really good.
Well, now that we got the 2,500 likes, we just need the at 78,420, we have 580 subscribers more. So you guys want me to buy that $1,000 of AMC and GME? 580 subscribers more on this live stream. Has to be by the end of this live stream. We now that we're looking at the same 6 bullet points, get out of here, ads. Ads away. Okay, here we go. So we have abuse of mortgage-backed securities caused the crash of 2008. It's happening again, this time with treasury bonds. Citadel is acting like Enron before it, playing all sides of the market and trading with itself in the dark with no regulation. This is securities fraud. They make fake gains and hide the losses. Seems like we're going to have to change one of these final bullet points, but how about these first two? How does that sound?
Yeah, they look good. They look good.
Okay, in that sense, the next one, among these violations are multiple instances of naked shorting, where they can unilaterally create securities out of the thin air, driving market prices down so they can keep the difference in price. How does that sound? And you can take a second to read this. I think that's shill sniffing. Oh, sorry.
Instead of unilaterally create shares, I would just say like sell shares that they don't own.
Sell
shares.
Because
they're not really creating a share; they're just selling it before they own the share. Yeah,
that's a good point. Also, I think Shill Sniffing Dog is in this chat. Are you aware that he has become an overnight phenomenon, or she, or they?
Who? Shill Sniffing Dog?
Yeah. So this Twitter account is has actually tweeted at us for Rokana. So that's why I am on my best behavior right now to make sure that we actually get this out to Rokana ASAP.
Gotcha.
So we're going to change that language. I'm going to tell the graphic designer. Shill Sniffing Dog, if you want to come on the show and tell us how what kind of ethos you want to bring to the GME saga, let me know, because I would love to interview as well. I think he's in the chat as we speak. Citadel enjoys free reign to hedge against the economy, going so far as to short entire businesses to bankruptcy. They tried to do this with GameStop and AMC. We caught them first. What do you think about that?
I wouldn't say, we don't know if Citadel is the only one doing it. I know that they've probably got a really big short position, but I would just say any sort of hedge fund or any sort of financial institution enjoys free reign. Hedge funds enjoy free reign to do what they want in the economy, and that includes bankrupting a company or shorting more shares than actually exist of a company, and nobody is there to keep them accountable. So I wouldn't, especially going to like Congress. I mean, I wouldn't want to point the finger. We've got plenty of dirt on Citadel, but saying that they have shorted the entire business in the bankruptcy, nobody can even prove any of that. Does that make sense?
Yeah, that makes sense. So in that sense, let's make sure that we don't have Citadel as the very only one for number 4. Number 5, regulatory agencies. And these are the ones that we're probably going to have to think about changing because of your new DD of whatever you want to include in there. Regulatory agencies like FINRA and SEC have already been fining Citadel for these things. It's been going on for over a decade. Now with treasury bonds, it threatens the entire economy. So far, it's tracked the bullet points that I made on the whiteboard. So I remember this one pretty specifically. The SEC has already fined Citadel and friends. What do you think about this as the 5th bullet point?
So yeah, I think we can keep this the same. The thing is, the DTC is a private company, so they're not a regulatory. If they were regulatory, they would be around for about 5 minutes before. But I mean,
include DTC.
Yeah, I don't even think the DTC needs to be in this. To be honest, this is such a completely different animal. So just saying that FINRA and the SEC have already been fining Citadel for these things. I would leave it wide open to just say Citadel and the SEC have been fining various hedge funds for these exact same things. Been going on for. I would say even in the 90s. I've seen FINRA. I just posted about FINRA violations, short selling in 1999 for Merrill Lynch and all those people. So maybe just open it wide open. Regulatory agencies like FINRA and the SEC have been fining various hedge funds for these things. It's been going on since the 90s that we're aware of, or just say their citations start in the 90s. And then the same exact issue is happening now with treasury bonds that threatens the entire economy.
Oh, and that is the very last one. So we don't want to put the DTC in there, right?
I don't think so. And in fact, I would almost take the treasury bond line out. Okay. Because, yeah, it's important to know that the treasury bonds are being shorted, and the fact that the repo rate is going negative really insinuates that there's a big shortage of treasury bonds that are trying to be shorted. But I think the point here is to try and get the message to Congress that SEC isn't doing their job with hedge funds. You know what I mean? So maybe just if we were to take that last line out and just leave it to like FINRA and SEC have been violating or fining these different hedge funds since the 90s, and that's when the FINRA records actually start. So ever since FINRA started, they've been doing this. Okay,
so fining since the 90s, and then get rid of last sentence, basically the entire last sentence. Gotcha.
Yeah. Now with treasury bonds, it threatens the entire economy thing. Like, I'm not saying it doesn't. I definitely think it does. It's just
kind of like it's not now. Okay. Gotcha.
Yeah. They'll find when they want to start looking into it, that we can give them all the one.
Last bullet point. This continues to happen because for now, the Federal Reserve cannot stop buying back treasury bonds. The moment it stops, the bubble bursts and the entire country grinds to a halt.
Yeah, I would say I don't think I would say it continues to happen because of this. I would say the Federal Reserve is now obligated to continue buying treasury bonds because the moment they do, the entire economy grinds to a halt.
So,
or even just leave the treasury bond thing out of it because we're taking the previous sentence out. Just say the Federal Reserve is obligated to keep supplying money to the United States because when they stop, the whole country grinds to a halt.
Because the country grinds to a halt otherwise. Okay. Well, in that case, we're not including anything from your most recent DDs. Is that okay?
That's fine. It's fine.
Okay.
This is a much you got to spoon feed this stuff. You know what I mean?
Yeah, I see.
Yeah.
We really do have to spoon feed this. So that is, I'm going to send that off to the graphic designer. I'm going to pass it off to Mason one more time. And now we have this. We've got him. we have this in the bag to send over to Rokana to start off with. And when this graphic is done, we recommend that you guys send it off to your own congressmen. A bunch of you have already contacted out. This was from 2 weeks ago. Can you believe? That was from a while ago. 2 whole weeks ago.
This whole thing is just like, man, I can't believe how I can't believe it's already past Easter. I feel like you can spend so much time looking at stuff like this, and then we pick your head up. A year's halfway over. It's wild.
Seriously. This is an ongoing session. Honestly, Atobit is a co-host on the show. I've mentioned multiple times. Now that you have part 2 in the wake, I'm expecting you to come on a couple of times, maybe even between part 1 and part 2, to just speak a little bit more about your thoughts on the price action overall, like just the developments that maybe I can catch you up on, and then maybe I'll catch you up on right now, and then you can come back and tell me what you think about them once you dig into a little bit more about them. Because we have been noticing that Citadel has their lights on, right? People have been wondering if this has something to do with supplementary leverage ratios, right? Having to have more cash on hand. We read through DDs that essentially have these banks pinned against the wall of just having to find more cash, whatever reason it is. So looks like the market just closed. Let me ring that little bell. For today, if you guys were waiting for the price of GME, it is 158. Wow. So basically completely flat on the day. And for AMC, I saw that there was a small
What was the volume?
The volume for GME is 3.74 million.
It's pitiful.
So that I think it sets a record. I don't think we have 3.74 million, at least this week. AMC has 22 million, right? This is based on like 40 million is normally its average, but its 3-month average is still up at 163 million. So that's what it's supposed to be. But for 3 months now, we have really not seen that much volume, and AMC is actually up 5.5%. So in that sense, we are looking for the new DTC 007 to play around a little bit with that regulation. So I'll just start putting a catalyst out there. We have Mr. George Sherman going away, right? We know that he is going to be stepping down at least by July, while they are still trying to find a brand new CEO. We have Mr. Ryan Cohen filling the board with some of more of his own picks, right? And he is going to be since the last time we talked, the chairman of the board of directors come June 9th. So a lot of the expectations for GME in particular are coming around in the June area. We don't do dates here, but it's still a month or two down the line. So in terms of your own research, and once again, just to tie it even closer to GME so that people can ground themselves in case that is the stock they care about, what does this speak on behalf of GME, this House of Cards DD?
You know, I have to, the best thing that DFE did, he did everything that the guy did was just awesome. The contribution to all of this is huge. But he found, like, GameStop isn't going bankrupt, guys. It's just extremely undervalued. You know, I think a lot of people think that he, somebody correct me here if I'm wrong, and they will, but I don't think he realized the short interest on it. I think that was somebody else. Like, he got looking into GameStop and he was saying, like, man, their credentials look great. Their financials look great. And, you know, it's just because he decided to look. But then when he started throwing this stuff out there, somebody else was kind of like, hey, by the way, they have this really high short percentage. And so it just goes to show, like, the trajectory of GameStop at the end of you know, 2019, beginning of 2020, and then when it got hit with like when all the stuff with COVID and all the lockdowns happened and brick and mortar was going down, I think it was just kind of thrown into this bucket of, like, hey, they're going to go bankrupt. But now it's at the point where, like, squeeze, I'm saying irrelevant from the squeeze. Like, I still am very confident squeeze is going to happen. Don't take this the wrong way. But the financials of the company are extremely, like, this time next year, I think the company is going to be in a much better spot, because more people are going to realize, like, oh my gosh, this e-commerce thing isn't really that hard to take off. Like, it's not hard to build e-commerce. And GameStop's, there's supply chain for this type of stuff is huge. I think I heard something about them being able to like do direct access or direct suppliers with graphics cards and stuff, and being able to offer, like build your own custom computers and stuff through GameStop stores. Like, man, that's huge. That's awesome. So the value that this guy and these different people, it's like they're draining the swamp of all these old school people that don't know the gaming industry as well as these new people.
Right.
It's gonna be huge. I think it's a very, very positive outlook for the company.
So we talked about how GME's case for being an Amazon killer in the past, right? This basically the same thing that Chewy did, but for a very specific group of diehard fans, right? Some people love their pets to death, right? That's how Chewy got into that space with excellent customer service. E-commerce is a completely different service, right? It allows you to exist in a meta space, and any that crosses between the brick and mortar barriers of being local. Right. Sometimes you show up to your GameStop, and GameStop, once again, is always going to have that retail element of it. But now the next question is, how are they going to use their retail elements? But just to make it a little bit connected back to exposing Citadel and supporting GameStop, I know that your main goal with these DDs is to clearly articulate what is wrong with our current financial systems. So some people are saying, are apes effed? Right? Or is this going to be the start of something brand new? 8-bit for mayor, 8-bit for Congress. We have talked a lot about that as well. What are your aspirations with this DD moving forward?
I just hope that I can boil it down into a way where enough people can digest it. And if somebody takes one or two things from this and it turns into a much bigger thing where it gets to the right people and they're able to make something happen, put it in front of the people. It's what I was telling you with Rokana. My aspirations for this are still the same. I think that all I'm doing is pointing out the issues, and we really do need to be talking as much about solutions. The problem is this happens all of the time. We have these crashes, and then the greed never goes away. So you're always trying to either decide like what's the perfect balance of regulation. Should you have more regulation to where you have no longer like a free economy, or do you kind of leave it where you have no regulation and you just allow this sort of stuff to happen rampant, like nobody's keeping track of anybody? So I do think that over time we have done a really good job as a globe of keeping things in check, and it doesn't really take a whole lot to push that trajectory one way or another. Like this sort of thing where it was talking about, you got all this stuff happening under the surface. It could just take kind of one thing to trigger it all. It might not be what I'm talking about here, but what I'm talking about here is a big part of what's going on under the surface. So just bringing as much light to that and getting people to, people that aren't college educated, people that don't know what accounting is, people that don't know what finance is, just being able to get those people to say, you know what, I've always knew something was wrong, and now I understand a little bit more. That's what makes me keep posting this stuff,
And we greatly appreciate it for it. Let's just so that I can have a timeline in my head to prepare some content around it. When is part 2 going to come out? Around when?
God, don't do that to me, man.
Oh, no, I know. I didn't want to ask. How about you just give us like weeks to months to years?
You know what I'm going to do is I'll pop in on the show more and give you a little more breadcrumbs.
Ooh.
And because honestly, this is a really good example of like what happened with this DD. Was you and I talked about the very first time I was on. You talked about what was it? Everything Short?
Yes.
I think it was Everything Short. And I was saying, I said like this is going to be my next DD. It was the rehypothecation thing because I kept coming back to that.
Yep.
And that's what this one started off as, was the rehypothecation. And the whole thing started off with me looking at that OCC filing where you and I were talking about the they were increasing the minimum capital contribution. You remember that?
Yeah, I do.
Yeah. So the only person that objected to that was Susquehanna.
Right.
And so I'm like, why are you objecting to this? This doesn't make sense. And so I started digging into Susquehanna and found out there's a bunch of dirt on Susquehanna. And so I was like, okay, well, I'm going to take all of these hedge funds that are like really over leveraged and stuff and talk about how they're all connected to each other. Like they're all kind of paying the same bills to each other. And so I said, well, that is really centered around the DTC. So I wanted to describe the DTCs. You see what I'm saying? So it's like, you can do an entire DD on Susquehanna. You can do an entire DD on Credit Suisse. You can do an entire D. But I felt like the first place I needed to start was the DTC because everything kind of touches back to DTC. So whenever I start off doing something like this, the initial thought is usually never what the DD ends up being. It's really hard to put a date on it.
People are saying the Matt Damon of DD, that's who you are. Well, you guys heard it here, right? We are having trouble struggling all the way up to 79K, but there's still a chance, about 400 subs away. But if you guys if you don't care about buying more GME and AMC, at the very least, just know that we're going to have the Matt Damon of DD, Mr. Austin Tobit here more often. And if you guys don't want to miss out on a live stream with him, then the best way is to turn that bell button on after that subscribe button. So I have a question from Kristen Anderson. If she has a bank account with Bank of America, what signals should she look for to know when to close her account with them? And how should they determine which banks are safe? That's a just general question. What are you doing with your banks? And how are you going to know which ones are safe?
Wow, that's a loaded question.
Yeah.
Not financial advice to any of this, by the way, but it's going to be really, really hard to know what's going to happen and when it's going to happen. I don't think anybody is going to be able to prepare anyway for any of this. There's going to be like the few percent, like the small percentage of people that know exactly what's going to happen might have a way to prepare for it. But honestly, it's just like, you can't go and ask the bank to get all your money. You can't, you don't even know the money you have is going to be worth anything you're getting. And it's like, I don't know. I honestly can't even begin to answer that question.
So there you go.
I don't know. Like I wouldn't have a way. It's like, I don't know. I don't have a way to make sure that I've got my money or to get my money out, or I don't know, because it's not really the dollar bill that you're worried about anyway. It's the digital number that's on your account. So I don't know.
So a pretty sobering, honest interpretation from Austin here, which is that if you have your confidence shake to the core and you think that, banks used to be safe, but now banks are a terrible way to lose out on opportunity cost and the value of the dollar inflating, then you try to bring it into buying shares, but you don't even know if you can actually own your own shares after this DD comes out. So
that's the scary part for me too. I think for anybody involved is like, okay, it says it on our broker account, right? But is it there? Like, you paid money for it, so you're owed a share,
right?
But what you're getting when you request a share is not the global certificate. That is in the bank vault of Seeding and Company. What you're getting is an IOU for that share. But am I going to be competing against you? You, Andrew, am I going to be competing against you for that same share in that vault? Well, it's looking like it, because there's like 190-something% institutional ownership on GameStop. How does that happen if people aren't abusing this system that I've just posted here?
So if you guys understand about recursive shorting, right, we just covered that concept in the beginning of this video, but it's having their share borrowed to give to B and then gives to C, same process of this short still covered but belonging to 3 people. It seems like it's not that. It seems like it doesn't even have to be that complicated to own 1 share of GME. So we don't know if this is happening yet, but this share is locked away in some vault, and the people that think that they control the float here, which it's starting to look like more and more so that we really do control the float. We can have A all the way to Z. But these all people, if inside the seed vault, they all own the exact same share of GME, that's the truly sobering part. How do we know?
Without being able to get a better insight into seed and who they are. The fact that I've never heard of them until like this morning. I didn't put that last part of that post in until after I messaged you. That's what's crazy. Like, I think that should be a before you start trading, you should know these are the people with all the shares. Like, that just seems like a disclaimer that people should know, you know, like, why have we all as a community been able to go this far without knowing that? That's just wild, because it's kept secret for that reason. It's like the fact that the DTC is like, everybody has this impression that the DTC owns all the shares. Well, that's not necessarily true. They don't own them. They have an enrollee or a subsidiary. Are they obligated to give the shares back to DTC? Can DTC request from them? I don't know. I thought the issuer could request their shares back from the DTC, but there was never a rule for that. So can CD be like the ultimate margin caller? Can they just be like, all right, everybody pay up, and just like bankrupt everybody? I don't know. I don't know any of these questions. So you think that, well, there is a possibility then that CD could be the superhero we've been waiting for. It's basically one organization or an arm of an organization that could ultimately say, hey, since I own all the shares, I would like to see the people who raise their hands and own this share. And if it's too many people, then the person that short sold recursively or even naked sold shorted should then pay up. Are we starting to see some of that action coming on soon? DTC trying to make these, because wouldn't that be easier? Why would they have to create all these regulations in place? Yeah, I think that's the big thing that points in that direction. Is like, if this wasn't a big deal and they were 100% in with these hedge funds that have been, you know, quite frankly, just robbing the system for all of these years. If they were really in bed with them, it would be hard to rationalize why they're doing this. If they're doing this just so they can say that it looks like they're doing something about it, I don't know. It's kind of ironic that they start posting this stuff and then this news comes out about Archegos and Credit Suisse. And regardless of what it says in the media of what's happening, the reason why it's happening is because they're over leveraged. Plain simple. They owe more money than they are owed. And they can't get, or they owe money and they can't get it. And they start defaulting. And all of these proposals, they have little nitpicky things about them that start triggering those events. So it seems really weird. That's the whole point. Like, when I started talking to you about this, it was like, you asked me, you know, what is the relationship there and how does it exist? I still think that the intentions of the DTC were good when it was founded. Right. And then it realized that its participants were big money and they really couldn't say no to these people. But now it's like they're realizing how much hot water they're in and they're trying to cover their butts. I think that's a really good point, is that this is basically a Disney movie. Have you guys seen like Raya and the Last Dragon or something like that, where they have like all of this power in the universe all concentrated together for a good cause, right? A MacGuffin. And then this person with all the money is like, wait, shoot, I have all the money. And then they have this Dr. Manhattan moment where they realize that they can do whatever they want. Yeah, so it's hard to, I mean, take CD for example. They may have the actual global certificate, but whoever bought the rights to that actually owns it. So going back to the thing I was just saying a minute ago, like, I don't think they would be able to trigger anything out of any of this because they don't have the actual share. They have, in fact, it's a liability to them because now they owe it to the person that bought it, like me or you. So it just, why is it so hard to go from the person that has the actual physical share to the person that buys it? Why do you need all of these steps in between here? You know what I mean? There's a really good article. I can't tell you what it is off the top of my head. And a matter of fact, I really only read a couple paragraphs of it where I just got like extreme confirmation bias and I just stopped reading it. But it was talking about how market makers, this really started to become, I don't know if it was a Congress hearing or something. They had like 6 different hedge funds in there too. And Citadel was the only one to object to like meeting regulation because they were advocating like regulation got us into the financial crisis of 2008 to begin with. And it's like, shut up, Ken. You're never talking about. This has nothing to do with, this has everything to do with people like you being greedy and people like us thinking that there's a way to solve your greed through regulation.
Right.
And there's not. But the fact that market makers can operate in the dark with hedge funds to do what the DTC is doing, I don't trust any of that. I don't trust the DTC anymore. I don't trust the reports that I get from Citadel, to show us what their financial statements are supposed to look like. It's hard to tell what's what. It's really hard.
I'm going to answer Nicholas's question that, is there a threat that Robinhood will not pay out when we moon? It's their problem, right? Even if it's all IOUs, it's their responsibility and must pay out. Reminder, Robinhood is just a broker. So they, unless that scandal about them having an actual position in GME is true, they're just facilitate the trade. So I'm still trying to figure out why they took the fall in the congressional hearing. So maybe you have some thoughts about the very first one where everyone should have been angry at Citadel, but instead everyone was like, Robinhood was the one, and Ken Griffin is like, yeah, Robinhood is the one that's in trouble.
I don't know, man. I think Robinhood is not innocent.
No, definitely
not innocent.
Definitely not.
The fact that you should know your business, and if you have a group of people invested in a company that all of a sudden starts to go way up in price and you don't have the money to cover that position, how do you handle that situation? Where do you go to get the money from it? Well, you go to a more reputable broker, right? You have somebody that's got a much bigger capital pool to do that. But the problem is Robinhood was never designed to be this big broker. They were designed to be a firm or an app that you can download to make it easier for people that have never had stock trading experience, primarily people that are on lower income. They made it easier for someone to take $20 and throw it in the market and see what they can get out of it. And so when you're dealing with when your customers are typically much lower income people, you don't think that you're going to have a much bigger capital balance to have to pay those people because you're dealing with a smaller amount of money. So this situation was like totally out of left field for something like Robinhood. I mean, it would have completely like bankrupted them if they had to pay out on something like that. So
this is my first. I haven't seen Shill Sniffing Dog's comments in my live chat yet, and he says, "Good boy knew the congressional hearing was a kangaroo court from the get-go." So it seems like Shill Sniffing Dog is in the chat. Once again,
that's awesome.
Do you want to tweet at me, Shill Sniffing Dog, to come on the show? So once again, sorry to cut you off.
That's fine. Yeah, that's me just rambling at this point. I've only got about 5 more minutes before I gotta hop off. But yeah, Robinhood, I don't believe for 1 second that it's like if we didn't stop trades, like man, you're owned 40% by Citadel. You receive a bunch of money from Citadel. At least that's what I've heard. Their ownership is like 40%. You receive a bunch of money that I know for a fact from Citadel, along with all these other brokers that receive a bunch of money for payment for order flow. And Melvin is kind of like this puppet of Citadel. And it's just Citadel's name is too much all over this. So if Robinhood goes into Congress and they have to testify, and Vlad had to testify about it, he did have his part. and he needed to explain why he stopped trading. But what he needed to say was, my dad told me to. He didn't need to go in there and say, if we would have had to pay for these, we would have had to pay millions on. That's too bad, man. That's your fault. That's your fault. If you don't want this sort of problem, don't set yourself up in a situation with somebody like Citadel to be able to pay. Like it smells too fishy.
The righteous fury of Atobit. And I agree. Yeah. Don't put yourself in that situation if you're not ready to pay for it. Nicholas Guilloc is asking a question about, and this is something. Oh wait, so we already talked about Nicholas's question. This is a question that I have as well. And Alexander Pillow Russo is asking, Andrew, why is it an issue that multiple people have an interest in a single share as long as the chain of interest is maintained? There's a lot of important questions that you listed about the CD holding one share that multiple people might own together. But let's just make it as clear as possible for Apes. Why is that a problem?
So it when this system was created in the 80s, it was apparent that having trades perform on an internet-based broker or an internet-based ledger, you could do trades a lot faster.
Right.
Okay. The problem was when you're not actually physically exchanging a share, which agreed is a very slow, inefficient way to do it. Unless you plan on buying one and then holding it for a long time, it's a very inefficient process. The problem is you're exchanging efficiency for accountability. And when the second you give up the right to say, I don't care about the physical certificate, I just need to know that it's in my account, the purpose or the intention for, I would say 99% of people that are trading, it's got to be a very small percentage of people. 99% of people that are trading just want the money coming in one day, and then they want to be able to sell that share a couple days later, or price goes up $15. Oh, I'm going to make some tendies, and then they get out and they don't really care about the piece of paper. They don't care. So at the end of the day, that share can be traded a bunch of times, and it doesn't really matter if you had the piece of paper. It just matters about the money. And that's kind of what the whole system is built on, is this fact that nobody really knows how many shares are in circulation. And if you don't believe that, take a look at another very, very relevant example. Microsoft at one point didn't know how many employees they had. Think about that. You have a company as big as Microsoft, and you don't even know how many people you're paying, because they asked like a bunch of different people to do a report, and they all gave them different answers. So it's the same thing with the stock market, right? Now you're leaving it up to multiple people to trade shares that they're not sure that they exist, because the only one that actually physically exists is held in this little company that nobody has ever heard of. So if we, as owners of stock, start requesting that actual physical share, or the IOU, where they give you a nice fancy IOU that says one share of GME or something, if we start requesting those, I have a really good feeling that it's going to start stirring a bunch of stuff up.
So it's the Swiss bank, money is in a vault, or the Game of Thrones scenario where there's the US dollar coming in, could be as worthless as this actual piece of paper here, right, in motion pictures, fake $100 bill. But the difference is that a real $100 bill has a counterpart in a bank somewhere. This is the current dilemma, is that we don't know if that's the setup the exact same way. Maybe the government has to come out, maybe the SEC and the DTC have to come out together holding hands, and they put their hands together and they say, we knew this was happening all along, sorry. That you have to know that this is just how the economy is run. That could be a satisfying answer. It could also be, hey, we didn't want you to know about this, but yes, you guys all own the same share, and it's fine. That could also be a satisfying answer. But as of right now, we don't have any answers as to this bombshell.
Yeah.
And at the end of the day, I think we owe you one huge thank you for bringing it to light.
Hey, man, I appreciate it. I'm glad to do it. I do have to drop, but yeah, it's just food for thought. It's a lot of stuff to think about, and I'll be back on very soon. We'll talk more about it. But honestly, for anybody listening, expect a couple days or a few days off for me at least. I just want to go outside for a bit.
You do need that. Enjoy the atmosphere. Thank you so much for putting extra hours in. You know, losing sleep, make sure you get them now. And I'll be checking in on you on a day-to-day to make sure that you're taking care of yourself.
All right, brother. We'll talk to you later.
Talk to you soon. And now that we're jumping off that call, I do want to check if we have made that goal. Let me see if I can make sure that on this stream we were trying to get up to 79,000 subscribers. We are 414 away. So I'll give you guys 5 more minutes to ask me any more questions or try and get up to that goal. 400 more subscribers, and then I'm going to be buying that $1,000 of GME and AMC. We're getting real close to 80,000, an auspicious number for sure, to the goal of 100,000 subs, and that's all you're going to hear from me about this today, right? People cycle in and out. I'm not talking to the people who have already did the hard work of hitting that sub button, that notification button, and that like button. Not talking to you guys. Unfortunately, you have to sit through it. I am sorry. I feel for you. I don't like listening to it when a YouTuber talks about it either, but we have had 63,000 playbacks. So every 10 seconds, you're going to be seeing a drastically different room of people. And I'm really glad that all of you had at least a piece of it. I recommend going back and really giving each part of this video careful glance, right? You can watch it at 2x speed if you really need to and you don't have the time. I recommend being able to dive into Mr. A. Tobit's work piecemeal to make sure that you have actually covered the pieces in there. And I want to be able to answer any of the questions that you still have in the comments below, starting now. So if you were asking questions a second ago, I'm going to start reading right now. People are saying thank you, make sure to get some sleep. Josh Sonderman is asking, discuss why the interest for borrowing is still so low for GME. Like we said, if you guys are here for the long haul and you have turned your notifications on, you are going to be able to make a Austin Tobit's next DD part 2, as well as whenever he just comes on to drop some breadcrumbs about part 2. So I'm gonna give him a big thank you. Thank you, brother. I was not expecting this to come out today. Usually when we miss a deadline, right, we were expecting to have him on yesterday. But if you miss a deadline, that's fine. No one's expecting you to like just jump around and be ready to actually get on the horse tomorrow. And yet he did. This is really great. Hold on a second. People are saying that we also have other DD that we cover, right? I cover bell to bell. So we really do cover this entire stock market bell to bell every single day. So if you guys want to be able to cover stocks that are not just GME and AMC, like someone who just said Senseonics is a stock that they care about, right? We care about Tesla, Dogecoin, right? So some crypto as well. So if you guys have an inkling to get up to that financial freedom, that sense of being able to get to a certain level of financial freedom, learning about passive income, and that motto right there, 6 figures in 6 months, right? Somehow we're going to be able to get you up there. John A says, I'm going to call WeBull and request physical copies of his shares tomorrow. Please update me on Instagram, right? Andrew Mo Money on Instagram or on Twitter. I have a lot of messages to go through, but I'm going to be watching up. I'm going to be waiting up until then. We got Ducks in the chat. How was the Matt live stream today? Let me know. Thank you guys so much for getting in the chat, right? Making it clear that we are having a conversation here. You guys ask questions. It's like a lecture where people actually pay attention. You guys have questions. We have answers. Let's see. Oh, you guys again says, Andrew Mo, would you support the idea we have created a self-driven community that is immune to the prying hands and eyes of fraudsters? We're getting close to it for sure, right? This is with the 6 figures subscriber count we're trying to get towards. We started off with, I think, 75,000 at the beginning of April, and now we have hand over fist started to crawl almost to 79,000, which is the goal of this live stream. So we're not probably at the rate that we're growing, not going to be able to get to 100,000 in this month, but right, we are still looking for major catalysts in the near future. Let me see if they have any other questions here. Let's see. Question about Senseonics. Julian Sheets says, check out Kenny G interview where he brags about the 87 crash. Ooh, if you are a moderator and you can help me Google that and put that in the chat, we will check that out in just a second. Yeah, we are getting pumped. AMC was up today, right? So let's take a quick look at those markets. AMC was up today from $9, and the last time it closed was $9.28. So it went up 50 cents on the day, right? We saw it crawl basically an hour and a half before market closed over 963, where it was trending below almost all day. So AMC was in a good shape. GME, on the other hand, we've been tracking it in terms of technical analysis most of the day. We saw that it was building this wedge right here, this pennant, that we were likely going to start trending sideways after that. That sideways trend occurred, and after a good amount of sideways trending, we are now playing around with basically absolutely no volume and not a lot of damaging negative pressure either. So yeah, so today, big nothing sandwich for GME. However, if you're curious about what's going to happen here in the after hours, we're going to release a video in just a second about just that. Carlton Breezy says, what's your thoughts about the SEC filing from last Friday? They mentioned 22nd deadline. Ooh, we have a video about that SEC filing that came out 2 days ago. I think on Monday or Sunday. So go check that out. It has, I think it has Gary Gensler on the thumbnail. Yeah, but people keep asking for dates. We're not trying to get a date-heavy narrative here, right? We're just making sure that we have covered all of the tracks of having a holistic picture of what to look at. So let's break out of this. Okay, any more questions here? Nate P says, Andrew, will you do a live stream on what banks will be safe and where to keep money after the 10D train lands on the moon? Heck yeah. So I think that will make sense for the next few questions that we have to ask 8-bit. Oh, also, speaking of that, we have some notes on those bullet points. So I'm going to send those over to, I believe, so that graphic designer is called Flip? No. Inky? No. Someone is suggesting that Mr. Gary Gensler come on. Here he is, Vampire Box. So a few notes about the graphic. Can you update and send as file? Let me know if you can't read these notes. If you guys like those 6 bullet points, they are in the description down below. Mr. BW Ritter was the one that drew up these 6 bullet points, and the one that once we fine tune are going to send over to Rokana. These things really do take some email chains. Emailed Mason and Austin 2 weeks ago, and then followed up on Monday. So these kind of things just take time. Okay, any other questions we have here? Rational Reminder says Patrick Coleman. We have Joshua Wardell says Seed & Co. shares a building with S&P Global Ratings. Food for thought. Okay. Ella Rose says, did you guys see the Iron Mountain shred trucks in front of Citadel today? Hilarious. I did see someone talk about that in the chat. I wasn't sure if it was trolling, but if it is really happening, Citadel has some papers to shred right now. Okay, any other questions you guys have? How close are we? So close, 311 subscribers away. Well, we're just gonna have to do a bigger and better goal for 80,000 subs, which we're gonna get real close to coming up tomorrow. So that's gonna be the next. That's gonna be the next goal, and if we can get that on the live stream tomorrow, you guys are gonna hear it first. I'm gonna buy another $1,500 of GME and AMC. Ah, there's that link. Thank you. Both Mighty Brows and Chris Rakes found it. Give this mod some scissors in the chat. We appreciate that. This is the way. Also Vegas Chef Andrew. Oh, wait. Message deleted by the Google moderator team. Google moderator team? Are you in here? Did we get you guys wow, that's scary. That's a freaky message. I don't like it. Wait, whoa. I don't seem to be able to click on this link. It leads directly to, oops, something went wrong. So this is getting a little scary here. Let me try one more time. Mighty Brows, it has a link. I'm just gonna copy and paste it. Here we go. The trade that made Ken Griffin a boy genius. So this is the link that you guys mentioned that we should look at. The trade that made Ken Griffin a boy genius. Can really picture him with that that hairstyle too. Boy genius hairstyle. Okay, let's take a look down here. There we go.
Graduated.
It's a 1 minute long video.
Did you say, I'm now going to do this full time? You're going to love this. Timing is so important in one's career. When I started to engage in convertible bond arbitrage in '87, I literally launched in September of '87. And I was very confident as to how this portfolio would behave in a bull market and very uncertain as to how it would behave in a bear market. But the mathematics on the way down are just much more nebulous than on the way up. And so I was short more stock than my back of the envelope math would tell me to be short. And what happened a month later was the crash of '87. And so at that moment, I became boy genius. Now I knew I was boy lucky because I was short the market intentionally, but outside investors go, look, this person's a genius. He made money in the crash. So that was a very defining moment in my career, was the crash of '87, and being net short gave me a track record early on that was attractive to investors.
Wow, he made his money with shorts, killing and making a killing off of the crash, a financial crash that left thousands, millions of people hungry and out of work. Okay, that's a pretty clear statement on the kind of person that Ken Griffin is. Okay, wait one sec. Hat with a propeller, maybe. Oh, ML has dropped Mo coins. Okay, let's take a look. You guys, we are thinking about creating some NFTs with these, although they are going to require more work from my part because we have some pretty nifty little coins here. Let's take a look. Ooh, a drop box. There's bronze, silver, gold, and diamond. Holy moly, okay. Download. Oh, wow, this is almost a gigabyte. Let's see. Can't hate Ken for being honest. You can hate him for the kind of shenanigans that he was up to with your parents' money. And your parents and your grandparents. Seriously. Joseph Morgan says, they have a question. If the shares are all owned by one branch of the DTC and they have no obligation to give those shares out, how will a squeeze ever be triggered without SEC intervention? The squeeze is triggered by how much money the short positions have, right? It's not about how many shares and who controls them, because at the end of the day, even if it is all contract for differencing, even if it is they're just pretending like you have the shares, you still technically do. It's just not a physical copy. So let's see if we can put some sense into this, right? Let's say that there's only one GME share, worst case scenario. This GME shares is locked in a vault somewhere, and GME says, I'm issuing this many shares. When the CD and company take that share, they just lock it in a vault and say, anybody who buys and sells GME is actually just buying and selling this one share. So this goes out to every single person, and everyone else who is trying to buy more than one share, we just pretend that they actually own this share. multiple times. Well, when it's time to settle up that debt obligation, because of the amount of money, remember we make a thermometer here. I make really bad thermometers. But you have the thermometer here that is tracking up to how much money the until we hit certain margin calls. So this is margin call for Melvin, right? Margin call for Citadel up here. When it gets to the price of GME that actually causes Melvin to get margin called, he is still going to have to cover all of the shorts that he has done. Naked, recursive, doesn't matter. If he's shorted GME, he's still going to have to cover it, and it doesn't matter who owns it, right? It just shakes your trust in your democratic vote in the system if it turns out that whenever you are actually trying to buy a share, it's just one guy with a lot of shares of GME in a vault somewhere pretending like you are. Joseph Morgan, hopefully that answers your question. Heather says KG is only 52. That would have made him 18 in 1987. I guess that's why he was a boy genius. Yeah, I guess that's why he's a boy genius. The thermometer. Guys, please don't make fun of my thermometer. Oh man. Said Warwick says we can't hate Ken for making money off a crash which he didn't cause. It's what they did in The Big Short and the Apes that in that film. So what we're doing, difference is Ken is responsible this time. So it's basically like a old story where he was Luke Skywalker before, but now he's I don't know. I guess it's kind of like Anakin's story. Sorry to bring up the prequels, but it's kind of like he was the boy genius before that took advantage of a coerced action. Maybe he saw that the program had a bug, and whatever he saw, right? He saw that there was an opportunity to make a lot of money. And he did, off the backs of a lot of people like your parents. And then he is now back doing his same thing. So how can you blame him? He just does his same exact things. Can I draw a mustache on him? I think I can. One sec, I just gotta move it over here. Oh baby, I'm gonna draw a mustache on you so good. On all desktops. Can I draw?
That was a...
Should be all desktops. In that case, I can try and draw here. No, I can't draw. I'll just move him over here. Now I can draw on him. There we go. There we go. Very nice. Big old Waluigi mustache here. Big mustache. Perfect. All right, so that's that's the show. I really do appreciate you guys hanging on until here. I wanted to make sure that you guys had a chance to get up to 79,000 today. Just 284 away. Close enough to the goal. So that's why I'm upping my contribution to AMC and GME another $1,500 once we hit 80,000. Likely gonna be tomorrow. Hope you guys are gonna have an excellent end of your day wherever you are, right? Even if it's the beginning of your day, I hope you guys are gonna have a wonderful beginning to the end of it. And if you guys had any other questions for me, drop them in the comments. Make sure that you guys are spreading the live chat faster and faster, but the best way to be able to make your voice heard is to come back after the show is over and drop a comment down below. And if it's a question that we didn't get to answer during the show, I'll be scrolling through them and answering them in the comment section. If you guys like Professor Meatball, you'll probably like going off to some of the links down below, including AndrewMomoney.com, where we have brand new merch. We have, oh, Mr. Monocle Man. There we go. I can't stop doing it. Okay. You can go to AndrewMomoney.com to check out some of the brand new merch. In fact, we have limited edition everything. This stuff just goes away like hotcakes. Let me get rid of all this junk. We have brand new Meatball shorts, shorts. We have Moneyball snapback hats. We have Candace shirts for whoever understands that inside joke. Of course, this is one of my personal favorites. I'm gonna be wearing this soon. We have Diamond Hands extra comfy hoodie. So we have a lot of clothing for you, for your body, as well as mugs for your face. So again, if you guys haven't gotten your 2 free stocks from WeBull, that's a good way to be able to start investing and use the technical trading tool that I use. If you've gotten your free $250 of free Bitcoin down below, that is a good way to be able to start investing in crypto and have an 8.6% interest rate app. If you guys are wondering how to get started, we have some books that you can buy from Amazon, as well as some cheat code algorithm that plugs in directly to TradingView, and then you have the opportunity to see the ups and downs of the market in real time. And we have like over almost 100 happy customers at this rate. Jump on using the link down below. So once again, a lot of different ways to support the show, and a lot of them are just beneficial win-win collaborations. And some of them are just buying some fun little merch that has Meatball's face on it. So again, thank to all of you who support the show for the Moon Platoon, the Meatball Space Legend tier, and the Gorillionaire tier, just making a clear ending here for you guys. I appreciate you guys. Thank you so much, and we'll see you